About You holding, clearly About You, might move more than Zalando, but I picked the bigger one. So we've got Zalando in focus. Adidas also in focus. German authorities have raided the Adidas headquarters as part of a tax investigation into customs and tax regulations. So we'll certainly watch that one as well at the open, Guy.
Okay, let's talk about the big picture, then we'll get back into the single stock narrative and figure out what is happening there. Time for the opening trade. Here it is. Let's take a look at what we're seeing here in Europe this morning. FTSE a little soft out of the gate, not by much, down by a little bit. IBEX is down by 0.2%. Remember, you're going to see the Inditex story being represented by what is happening with the Spanish market at the moment. So that's down 0.2%, falling a little bit. The FTSE 100 continues to drop a little bit as well. Stock 600 down by 0.1%. There's a number of single stock stories that could actually influence the bourses today. Inditex is definitely one of them. Is politics going to influence the French market? Not at the moment. It looks like it's largely in line with what we're seeing elsewhere around Europe. So what is happening below the surface? Let's get back to the sectors and the single stock stories. Credit.
Well, right off the bat, you are seeing some of your heavyweights actually move it to the downside. So Total, for example, Novo Nordisk, a lot of your French names are the underperformers this morning when it comes to the weighting and the contributions that you're going to see there. To the upside, though, Anna, I'm seeing a little bit of a defensive push when it comes to, say, ASML, for example, among some of the more kind of consumer staples names that we traditionally look at. Those seem to be moving the market. But to me, this feels like a risk-off kind of day.
Yes, it does feel a bit that way, doesn't it? And we're waiting for some of the key stocks we mentioned to open. So Inditex, the bid activity around About You and Zalando. We're waiting for all of those stocks to open, so we'll see what we get there. But yes, the more we look, the more these sectors are dropping into negative territory. We're down by 0.4% on the FTSE 100 now. The DAX still not open, and we only have 3 sectors in positive territory. Basic resources is the worst performing sector, which speaks to that weakness in London. The likes of Antofagasta, Anglo-American, Rio Tinto, all a little bit weaker. We actually had mixed signals coming through from the commodities space overnight, with iron ore prices, yes, a little bit weaker, but I think copper was trading higher. So those mixed signals, though, resulted in a little bit of negativity. Still, the DAX not open.
Come on, get on with it. We need to get some numbers posted on our screens and figure out what is happening. I want to see what happens with some of these fast fashion businesses. I want to see what happens with Technica as well. You are seeing some weakness, as Anna says, in the mining sector. Luxury is under a little bit of pressure as well. The China story is interesting. It is a show me the money story now, definitely. I think people have been once bitten, twice shy, maybe, with this stimulus story. So that seems to be in kind of rippling through, maybe into the European space. It's fascinating that the euro and the Chinese yuan are now trading with quite a tight correlation. That relationship seems to be getting more and more important at the moment. So keep an eye on kind of how that European-China story kind of flows through. Zalando now looks like it's open. It is down by 8%. On the back of its acquisition. Adidas is also falling this morning. It's down by 1.41% this morning. So you are seeing some of these German names we were mentioning.
It's interesting, isn't it? Because we've got the M&A news, and that's one dynamic, but that pushes in the other direction versus the Inditex update, doesn't it? So, you know, there's both of those. So although Zalando is down, as you say, there's this M&A story, and that directly involves them. There's also a weaker update from Inditex, and I wonder how that ripples through the rest of the sector.
And we are seeing the opening price of Inditex here down about 6% this morning. So we'll see how that all shakes out, which is interesting because the sales numbers came in a little bit higher than expected, but there's clearly something within the numbers that the market is not responding to. We're going to get the details in just a little bit, but let's get an expert voice around here around the table this morning. Joining us is Elise Bedoy, Head of Research for EMEA over at Citi. Elise, pleasure to have you on the program. Thank you so much. I feel like I want to start with maybe the point that Guy made, which is this China read-through. We've been talking about it for the last couple of days here as we get headlines out of the Chinese policymakers and what that stimulus picture actually looks like. How do you play the China story in Europe?
So basically, Europe has been the unloved market, very much so. It's a consensus almost underweight, and US consensus overweight. So we believe that actually it's the right time to potentially, close some of those underweight positions and look at Europe. We see some upside risk, and most of it is actually China. Some relief coming out of China could be very helpful. And how to look at this, obviously, I would say we've just gone overweight luxury goods. That's a very nice way to play it. So there are some sectors that obviously are going to benefit within that. But broadly speaking, it's a general sentiment, because obviously China, plays out in many different ways. In Europe, some cyclicality as well could be helpful. So we've got an overweight on luxury goods, but also an overweight on some cyclical spaces which could benefit.
When it comes to that kind of China maybe pain or overhang, could U.S. economic resilience make that up, especially when it comes to, say, the French luxury makers, for example, given that so much of the mass market story is in the States?
I think a lot of it, Kruti, right now is blurred by the uncertainty around tariffs. So I'm afraid all of that potential positive that we see that's embedded in Europe that could happen, and all of that overflow that could come from the, let's say, soft landing in the US. Unfortunately, at the moment, investors are very much willing to see what happens to tariffs. Yeah. And when they get implemented, are they laser focused on the sector? It could be luxury, it could be winemakers, but where is it going to happen? And I think, unfortunately, until we see some easing on that, but that's one of our positive cases, are we going to get negotiations rather than tariffs, etc.? That is the moment at which you start playing that. But
okay. Yes, and in terms of the timing then, so you think that Europe is undervalued, you think there's a lot of pessimism out there. We know that European stocks have rarely been this weak in relation to US peers, so relative underperformance has rarely been this bad. So what's the catalyst for that to change? I mean, you've mentioned something around tariffs, and maybe we get negotiation on tariffs. Are there other catalysts that we can look at then, Elise?
So I think the issue is there's not one silver bullet. It's actually a myriad of catalysts that we need to come together, and almost like to come together at the same time. So I distinguish, I'm going to try to be, I distinguish the fundamental ones and the I would call that the sort of political sentiment ones. So you've mentioned we're waiting for a prime minister in France. Now, that's not going to solve the French issue, right? We have political uncertainty in one market. We've got German elections. We think, German elections could be one nice catalyst. But the broad 5 catalysts that we see, one, probably a ceasefire or something better in Ukraine. And we don't hear much about that right now. We hear so much talk about tariffs. That's one thing. Tariffs, obviously, as soon as we get news that maybe one industry specifically is negotiating rather than going into tariffs, as soon as we get a view in January, for when actually some of the implementation might happen, that's going to ease some of the issues. And I would say that the third one really is China. And that's, some news coming out of that. I would mention one thing that I think market participants are not really looking at, that I think is a huge tailwind for Europe and European markets, and it's basically the strong dollar. And I think the strong dollar is not something that's being featured at all or embedded into things, because people are really looking at news flow and macro news flow.
Yes, and so if the Eurozone is more of an export economy than the United States, is the weakness in the euro going to be more beneficial than the strength in the dollar is going to be an issue for the United States? And
so that balance, and I think generally speaking, it's not something that's been looked at. I have a theory about that, and my analysts would have the same theory, which is that we're right now in a gap in news flow until the full year results. So you don't really have bottom-up information right now. Well, you do this morning. Obviously, retail tends to report at this time of the year, but that's an exception. Most sectors will report towards the end of January, beginning of February. And meanwhile, we're going to have, the ECB tomorrow. We're going to have all this macro news, CPI this afternoon. And so that's blurring, if you want, the bottom-up. I think the bottom-up could be positively impacted by the dollar, actually.
Is European weakness a hedge against US strength? Should I think about it that way?
Definitely so. That's the view of our strategists. Essentially what we have at the moment, we have this consensus overweight in the US, and we think at the moment, we're going to see things doing much better for Europe going forward.
So it's a relative trade.
It's a relative trade, completely. And when you look at the world, you have the US half the world, you know, in terms of equity market, and then you have Europe, which is within rest of the world probably the lowest value, so probably the upside risk. I would say we need to distinguish. I find that this is a feature. Most market participants tend to forget that, you know, Europe is not a proxy for European economies, right? Europe is essentially exposed to the rest of the world, so that is why it's your hedge.
The problem is, though, that it just kind of historically has been, it doesn't historically kind of work that way. I'm curious as to whether or not PMs are biting. When you take this to meetings,
it is tough.
What do they say?
It is really tough.
So there's no indication that there's going to be a change in the trade anytime soon. What would you need to see from PM? Do any of them kind of sit there and go, okay, tell me about that a little bit more?
I think that's the crucial question. We go in these meetings, and I think right now the feedback from investor clients is, we want to look at Europe, we want to understand. So I'll give you one trade that is very interesting at the moment that people have been looking into, which is that we've seen, you know, a real negative impact on US exposed European listed names. Okay.
Yep.
So, and it's been broad-based, and there's been no distinguishing between, you know, what actually is tariffs immune or what isn't. So that's one thing that people are looking at. Okay, this whole US exposure has been sold off in Europe, but actually there are probably names that are going to, on a bottom-up basis, do well, even though they've been punished unduly. So that's an example of places where they're looking at.
And that's gaining traction. People are looking at that.
Yes. Yes.
Okay.
How much more does Europe have to sell off for this to become a valuation play? And I ask this in the context of China, where we saw such a major sell-off. And even though some of the risks remained around the uncertainty, people couldn't stay away from it because it was just too cheap not to buy. When do we hit that dynamic in Europe?
I think actually we're forecasting European markets up 8%. Our new targets were yesterday morning. Beata put them out, and it's we're forecasting 10% up for Europe and 8% up for the FTSE over the next 12 months. In terms of, you know, we do need, you know, different data. We need probably, obviously we're going to hear from China at some point. But we have a lot of news flow in the way before we hear that. But we do believe that over the next 12 months, it will consolidate, and we will see that happening.
The negative sentiment around Europe seems to have coincided, and correct me if this is not the right impression, with a lot of the negative sentiment around the auto sector. Is that crucial to driving sentiment? Because I'm not sure we're seeing any solutions to that particular crisis.
No, you're it's a very interesting observation. In fact, as we tilt more towards Europe, we've actually just closed our underweight autos, and we're now neutral on autos. So it's something we've definitely observed that, you know, we believe that has probably troughed, and it's probably linked to that. But, you know, you see bits of news flow that are interesting. I think Japan was talking about negotiating for their auto market, you know, with the US. And so as we see that news flow, and as you see the valuation really troughing, if there's any relief, any form of conversation coming from the US, but we won't hear much until January, realistically, then that's going to help. And that is why we think now is the time where essentially Europe used to be a risk to own, probably after, let's say, you know, June time when we had the snap elections in France, the sentiment changed negatively. We think now we're at the stage where Europe, it's a risk not to own some of it.
Great to see you. Thanks for stopping by to see us. Thank you very much indeed. Elise Badeau, Head of Research, EMEA at Citi. Core 6 looks like this. Let's take a look. We were just mentioning some of the luxury names. What's happening with LVMH this morning? Under a little bit of pressure, as you can see, but not by that much. Ferrari's down a little bit. You're seeing maybe a rotation back into some of the AI names. ASML's doing well. Schneider's doing well. Nestle's doing nothing. Novo Nordisk, a winner yesterday, giving back some ground. Carl Zeiss, Zalando, TUI. There's some interesting names out there that are worth watching this morning. Lizzie Burden's got some details as to what is happening with the single stock story.
Okay, we've got a consumer theme this morning. Last I checked, retail was bottom of the basket on the stock 600. So let's start by zooming in on Inditex. Those shares are up 5% this morning after their results. Yes, they said that the holiday season is going well, but in fact...
Apologies, Lizzie. It looks as if we have an issue with the microphone, but we were looking forward to Lizzie's thoughts on Zalando. We do have, on Inditex, we do have weakness then. As a result of that, as a result of that update from Inditex, the stock down by 5.6%. And as we've said a couple of times, there's this dual dynamic happening in the retail space, fast fashion and other leisure wear names. Inditex then down by 5.7%, Zalando down by 8.9%, partly the Inditex numbers, partly the offer they've made within their space.
Carl Zeiss is down pretty sharply. Carl Zeiss Meditech is down, missed on the EBIT line, the operating line at the full year level. That stock looks like it's under quite significant pressure as well, so that's another name that we're watching. Is this narrative going to change a little bit later on? CPI data is going to be the dominant theme, but this morning it is the retail story. Lizzie, I think we haven't fixed the mic. We thought we'd fixed the
She'll
mic.
be back.
We'll be back, but we haven't now, apparently. Anyway, but we do have Siemens Energy also down by 4.6%. That's an interesting one because that could be some read across from GE Vonovia. I think we might have Lizzie back now.
Are you brave enough to do it?
I'm going to try.
Okay, you give it a go.
Third time. Let's go, Lizzie.
Third time's a charm, Anna. Let's start with Inditex. As I say, there was a bit of weakness under the surface in these results. Earnings before interest and taxes for Q3 just shy of analyst estimates, and traders picking up on that this morning. Shares down 5.6%. But staying with that consumer theme, let's flip over to TUI out of Germany. They posted this net profit increase for the year to the end of September, but the shares are down. Why? Well, these are decentish results, but if you look back to about August, TUI's seen this big jump, so maybe these results are just not decent enough for traders this morning. Flipping over to Adidas as well, of course, we had that raid on the company's HQ as part of this years-long tax investigation yesterday. Shares down 1.5% now. Does this dent that turnaround in the company under the CEO, Bjorn Gulden, since the Yeezy debacle? Flipping over to Zalando, these shares taking an absolute beating this morning, down now 8.7%. So you've seen the M&A news, the agreement to buy rival e-commerce company About You. Our analysts, interestingly, at Bloomberg Intelligence have been saying that it's going to need significant logistics efficiencies to pull this one off. So Zalando paying a hefty premium for what analysts see as a pretty rocky company in About You. We also have, if we flip over, Publicis, we had a change in the analyst rating there. JP Morgan upgrading it to overweight. And in fact, media is, as at last I checked, the best performing sector on the Stock 600 this morning, and Publicis top of the basket, higher 2.5%. Finally, Guy, you said to keep an eye on the French banks because we're awaiting that announcement, of course, of the French Prime Minister. Let's flip over. We've seen a pretty mixed picture for BNP Paribas, SocGen and Crédit Agricole. Looks like we're going to get more of a reading on what they reckon on the politics when we actually get a name.
Yes, indeed. Waiting for that by the end of tomorrow. Lizzie, thank you very much. Bloomberg's Lizzie Burden then with the latest on those stocks that are moving. We'll get more details on one of the stocks you mentioned there, Inditex under pressure. More on that story coming up next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is
indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The IBEX is down by 1.3%. The reason mainly for that is Inditex, as you can see. Down pretty sharply this morning. This after the owner of Zara reported slower sales growth at the outset of the crucial holiday shopping season. Rodrigo Huela joining us now from Madrid. Numbers are a little light. Why?
Why Inditex is down? Mainly, there are two. This is a quintessential Inditex stories. Numbers are good, numbers are solid, they're good numbers, but expectations are so high and its recent track record is so strong that any kind of slowing down in those numbers sends concern around across investors. To this, we also have to add the fact that the share is up about 40% this year. So there has been quite a bit of profit taking. So you have the combination of two things. Numbers are strong, but slightly below what people were expecting. We see it in things like sales growth, where people were expecting maybe 10 or 11% for the first few weeks of the quarter, and they're actually at 9%. And we also see it in a slight easing of the EBITDA, of the gross margin. And then the second point, as I was saying, is profit taking.
And is this a red flag, Rodrigo? Does this, I mean, it seems to be taken quite negatively by the market. The stock down by more than 5.5%.
Yes, so since the pandemic, Inditex has been growing a lot and with hugely, very strong numbers. So it has set a benchmark for itself that is really, really high. And I think that with these numbers, people may be coming to realize that that is not something we should always be expecting, that is not something that will happen every single quarter. So in that sense, it may be a bit of a red flag. But there doesn't seem to be any indication that this is, the start of the end or a big problem or huge issues. In fact, most analysts today were saying that they still expect their annual forecasts to be met.
Rodrigo, to what extent is Inditex the bellwether for the industry as a whole?
It is a bit of an outlier. I mean, when you compare it to its peers in the rest of Europe, it is always, or it has in recent quarters, recent years, been performing quite well and much better than the rest, in fact. So it's not always easy to look at what they do and compare it exactly and do a read across with everybody else in the quarter. So it's a bit risky to say, okay, if this happens to Inditex, it definitely means this will happen to the rest. However, whenever sales growth at Inditex slows, it is pretty safe to assume that something similar will be happening in the other players in the industry. So if Inditex's growth is slowing, it's unlikely that everybody else will be growing faster.
And those shares, of course, as we speak, down just shy of 6%. Bloomberg's Rodrigo Orihuela giving us that update out of Madrid. We thank you so much for walking through it. Sticking with retail, a story that some of us are very passionate about. TikTok Shop has made its Europe debut on Tuesday. TikTok's in-app shopping features launched in Spain as well as in Ireland. That's exciting. Is this where you? Is this where you shop?
I was there
daily.
Yep, often, never. This is interesting in as much as this is coming at a time when obviously the business is quite under pressure in the United States. But you've seen the politics around TikTok is extraordinary at the moment.
Yeah, absolutely. One of our opinion writers talking about this in the context of NVIDIA, saying the Chinese go after NVIDIA, the US go after TikTok, and there might be very genuine concerns about the way that it's used in politics as well. And we saw that in Romania just over the last few days or so. So that looks as if that question will run and run, even if we also get to do more shopping.
And all part of that kind of delisting debate within the exchanges as well that we're seeing in New York.
Let us turn to delisting. London's IPO market has declined 9%, or linked to the size of the listing market this year, with only $1 billion raised, pushing the UK to 20th place in the global IPO rankings. It's been leapfrogged by upstarts including Oman, a market with that's just 1% of the size of the UK, as well as Malaysia and Luxembourg. Let's get more details. Bloomberg's Sweta Gopinath joins us. And so this has been a sorry tale for quite a long time then, Sweta, hasn't it? So what's gone wrong for the UK's IPO market here?
It's not just one factor, it's sort of a confluence of factors. The number one factor, I suppose, is the valuation disconnect we have here in the UK. The UK trades at a steep discount to the US and to much of Europe as well. So there's little incentive really for issuers to come list in the UK market. The other issue is that investors in London tend to be very yield focused. Traditionally, this market has been focused on dividends rather than anything else. And the types of companies that tend to come to the IPO market are more growth centric, which means they can't sort of muster up the kind of buy side demand here that they can elsewhere.
In terms of what the competition that the UK has right now, what is it? Should we be thinking about the UK? Anna was making a great point earlier, and I was like, this is a really smart thing to say. The UK market is just to pick up on Cree's earlier comment, the UK market is a takeout target market at the moment, isn't it? In some ways, it's ahead of the curve in terms of attracting private capital. That's a valuation story. But should we be concerned about what is happening here if companies are simply going private and exiting the public markets? That's a theme that's happening across finance.
Because we were at this Women, Money and Power event yesterday that we were running here at Bloomberg, Sweta, and you couldn't move for commentary around private markets.
Yeah, de-equitization is definitely a trend globally. It's not as if the US is immune to this. But I think the problem we have here in the UK is that, on the one side, we have de-equitization, all these companies being taken out. But these companies are also being taken out at a faster clip than new companies are entering the market.
Right.
In other markets like the US, it's slightly more balanced.
Doesn't that mean just that we're ahead of the curve? We're just privatizing our markets. Isn't that we're all in on the private market trade? I'm joking. Yeah.
Well, sort of though, right? Apollo and KKR, they're part of the indexes now. It's true.
Yeah, but I guess, we'll be left with a market which offers very little for public market investors, right? If our market continues to shrink, if we have fewer listed stocks, and there isn't a real way for people like us, for you and I, to access private markets yet.
And there are IPOs happening, but just a lot of them are happening in the Middle East, is that right?
Yes. Yeah. So traditionally, again, international companies used to come to London. Now they're all listing in their home markets. Indian companies, Middle Eastern companies, companies elsewhere in Asia are choosing to stay at home rather than come to London because of this big valuation disconnect.
So that appeal of London as kind of that international hub maybe disseminating as well. But we're Sweta Gopinath walking us through some of that story. She covers a little bit of everything. Deal activity, IPOs, private capital markets. She does it all. We thank her so much for coming up on set. Coming up on the program, world leaders weighing the consequences of President Assad's downfall in Syria. Timothy Ash from RBC Blue Bay is going to bring in perspective next. This is Bloomberg.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building an organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. It's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Minutes into the opening trade, this is what markets look like across Europe, going nowhere in a hurry, to be honest. We are waiting for CPI that's going to come out of the United States a little bit later on. How big an impact will that have on the Fed? The mood music I'm hearing is not very much, but does it set the tone maybe for rate cuts or no rate cuts going into 2025? Geopolitics ever present, it seems, at the moment. Let's talk about the latest iteration of the surprises that we've had out throughout this year. The stunning fall of Syrian President Bashar al-Assad has blindsided so many foreign governments and unleashed a struggle for territory and influence within the region. The main losers, it appears at this point in time, Moscow and Tehran. The clear winner, it seems, Ankara. Joining us now, Timothy Ash, Senior EM Strategist, Sovereign Strategist at RBC Blue Bay, and an Associate Fellow at Chatham House. Good morning.
Good morning.
We're just joking as you sat down. You're not surprised by many things. Syria feels like it could be one of those. How did it happen so quickly?
Well, absolutely. I mean, if you think of the key driver, Turkey wanted to force Assad to the negotiating table. It had problems with 4 million Syrian migrants domestically. There's been a rise of nationalism in Turkey. They wanted Assad to basically make the country a better place to live, so those Syrians came back. And also Turkey obviously has an issue with Kurds in the north. It wanted a stronger central state, makes their drive for the separatism, etc., weaker. But I don't think the Turks even thought this would happen, right? And they were surprised. But in the end, they went with the flow, right?
Yep.
I mean, momentum was behind HTL. The Turks saw that they could get total victory over Assad, and that would be a great victory for Ankara, as you mentioned, and that's proven to be the case.
Is the Middle East more unstable with or without Assad?
A very good question. I mean, obviously there's loads of euphoria at the moment about Syria. I mean, Syrians, are euphoric about what's happening. I mean, the scenes from some of the prisons, extraordinary. But it's going to be very difficult, I think, to stabilize this country, right? Remember Libya, remember Iraq. Yep. You've got multiple ethnic groups in Syria, multiple militias who are fighting each other rather than fighting Assad. I guess the plus factor is Turkey is a dominant player, has a real interest in making sure this country works. I think the Gulf states will want to put a lot of money to work as well. They have that interest as well. Turkey, again, will benefit from reconstruction, all that kind of stuff. Syrian migrants will come back. It puts the YPG, the Kurdish separatist force, in a box in a way. But you've probably got outside actors that are still going to pay a malign impact. Iran. What is Iran going to do? Yep. Israel, probably its actions, I mean, it's in its own defense, it would argue, taking more territory around the Golan Heights, hitting, I mean, the biggest air raids by Israel on Syria in 50 years, taking out the whole of the Air Force, air defenses, all those kind of things. I mean, there was a possibility, I guess, for a reset in Syria-Israel relations, and actually Israel's actions have set that back, right? Egypt was very annoyed by Israel taking Syrian territory. You know, that's a complication as well. So, I mean, it sets off this new administration on the back foot and in a bad place in terms of relationship with Israel.
But sticking with that Turkey story, Turkey's always been kind of the negotiator of sorts between Russia and Ukraine when it comes to the grain deal, right? And then I'm curious, does that role continue? Does that get amplified as we talk about Donald Trump coming in, potentially negotiating some sort of ceasefire? Is that a partnership that Donald Trump and Erdogan may foster further?
Well, it's an interesting one. I mean, Turkey, the Russia-Turkey relationship was going into a difficult place in recent months because the Americans had pushed back on the Turks on sanctions, right? Secondary sanctions. The Russians weren't happy with that. But now the Russians, if they want to keep the Tartus naval base in Syria, they have to be nice to the Turks, right? And the US sanctioned Gazprom Bank. That made it complicated for Turkey to import gas. It needs the gas. Russia will have to give Erdogan something to be able for Russia to be able to keep something on the ground in Syria. I think in terms of Ukraine negotiations, Russian weakness has been exposed in Syria. That improves Zelensky's negotiating position. Trump met Zelensky with Macron at the weekend, and the messaging from Trump, I think, was quite supportive of Ukraine. Again, highlighting Russia's weakness. Weakness of Iran. I mean, that means Iran has been supplying a lot of drones and munitions to Ukraine. Will it still be able to? I mean, it will be thinking about its own defense rather than helping Russia out. Everything points to negotiations between Ukraine and Russia sometime in the new year.
Yeah.
Russia's now on the back foot. That helps Ukraine.
Does that show up, though, in the markets? Does that show up in Ukrainian bonds? Does that show up in Eastern European bonds as well as we get this kind of tit-for-tat negotiations and developments? Does it show up in the markets?
Well, it actually has done. Ukraine's been one of the best-performing bonds in the last 3 to 6 months because people expect peace talks. They expect peace talks. They expect some kind of deal. They expect a lot of reconstruction and recovery money to go into Ukraine. I mean, it will work. That story will work if the West is able to ensure security in Ukraine. If it's a proper peace, the peace holds, Putin doesn't go in again, and that's all about security guarantees. Is it NATO membership? Is it individual bilateral agreements between NATO countries in Ukraine? Is it just supplying Ukraine lots of kit so it can defend itself? I mean, that's the key. I mean, other interesting trades we've seen in the last couple of weeks, actually, Lebanon has rallied massively. It's been one of the best performers now in the last couple of months. The assumption is the weakening of Hezbollah, further accentuated, I guess, by what's been going in Syria, means that Hezbollah have to step back, play a more positive role in terms of election of a presidency in Lebanon, formation of government, and maybe then a reconstruction story also in Lebanon. So, I mean, there are some winners from a market perspective from all these developments.
Yeah, really fascinating to watch that play out. In terms of the Turkey story, Tim, clearly the refugees and migration flows have been a big way that this has impacted on European politics over many, many years. There are 3 million refugees in Turkey from Syria. Turkey would like some of them to go back. European governments have already started to not accept applications from Syrians because they say, well, you know, you may be able to go back soon. What should we know about the role that these play? Because there was a lot of money changed hands between Europe and Turkey for paying Turkey to keep some of them within their borders instead of allowing them to come to Europe.
Turkey's still a key player for Europe. I mean, if Syria is going to work, Turkey is going to have to be very active in working with politicians, particularly the HDL. I mean, it obviously had Al-Qaeda links. It's been sending a more inclusive message. Why? Because I think Turkey has been coaching it. It's been telling it what it needs to say. And actually the fact that, you know, the defeat of the Assad regime happened so quickly, I think was a part of the messaging out of HDL, that we're not coming after you. We're only going after the really bad guys, the guys who are running the prison or Assad himself. But we want to build a more inclusive country. And if that happens, then, you know, a lot of Syrian migrants will come back. I mean, it was extraordinary scenes over the last few days. I mean, 200,000 Syrian migrants have returned from Turkey in the last, 24, 48 hours. You know, I mean, it's a potential stabilizing factor for Europe if Syria can be made to work.
And do you see signs of nation building that look at all convincing? I know it's extremely early days and everybody is just, quote unquote, watching.
You know, it's very, very early, but I mean, they're positive signs, right? I mean, the HDL guys suggesting that the incumbent government can stay in an acting capacity. I mean, that's extraordinary, really, given the messaging around HDL prior to this, and you know, designated terrorist organisation. The West thinking about whether it takes that designation off. I think it's going to have to. Positive so far. If it doesn't work out, though, I mean, and we go back, I mean, you'll see different Syrian migrants leaving the country. I mean, Alevi, Alevite community is a big community. Syrian Kurds, for example, may opt to leave. I mean, that could be, you know, Sunni and you know, pro-rebel refugees could come back, but their opponents could leave the country. Kind of a swap of migrants.
What does a weaker Russia mean for Europe? I'm not going to talk about Ukraine, but places like Romania. What happens in Romania if Putin is weakened?
Well, I'd say a weaker Russia, longer term, is great for Europe. Yep. Because Russia is a huge security threat to Europe. So Russia needs to be defeated in Ukraine. We need a peace that, as I said, is secure. I mean, you mentioned Romania, very interesting elections. Obviously, we're watching another incredible, extraordinary situation. I mean, the cancellation of the second round of the presidential election, I guess, showed that this is really important for NATO, for Western security. They clearly identified in their minds that this was a Russian special operation, right, to get Georgescu into the second round. And the messaging suggests that he won't be allowed, one way or another, to win this presidential election. This is existential for Europe.
Why was the ruling by the judge, by the court, in Romania, why was it objected to then by seemingly so many other players, opposition and people who were trying to take on the pro-Kremlin camp? It seems strange that it was sort of criticised by many sides.
Well, I guess, you know, one wouldn't want to do that normally.
Yeah, you wouldn't want to be in that situation.
I mean, Lasconi, the pro-EU candidate, at that point seemed to be winning in the polls. They seemed to be getting their message over that, you know, they argued this is a Russian candidate. It's Russia versus the EU. Romania's EU future is on the line. We have to support the pro-EU candidate. The polls suggest she was getting that message over and would have won. So she didn't like the fact that, you know, she was going to win in a fair and square election, and that was taken away from her, I guess.
Connect the dots for us between Romania and Georgia, and I feel like those are the two countries that have been kind of mushed together in the news flow with, say, Moldova, for example, as well. But the fact that Georgia's protests broke out in terms of the EU extension, does that create a path in terms of how we think about Ukraine, Poland, others that are maybe thinking about joining the EU?
Well, the Georgia is just a rerun of Ukraine circa 13-14. Absolutely. I mean, it's pretty extraordinary, right, the similarities. You know, Yanukovych was going to join the EU or sign an association agreement. Russia came in with a financing package, I guess, read the riot act to Yanukovych, and then we had the demonstrations, right, and the rest is kind of history. And same in Georgia, right? I mean, you have Georgia Dream essentially going back on the population's EU aspirations, and we're seeing it play out. Clearly, it looks like Russian agents, Russian security types are helping Georgia Dream, you know, beat the demonstrators. Basically. It's a real. These are all the front lines between Russia and the West.
Does this go away if you get a peace deal in Ukraine? Does it get heightened if you get a peace deal in Ukraine? If Russia is struggling in places like Syria and by extension Africa, does it refocus attention back into Europe? What is the game plan in that kind of scenario for a weakened Putin who is clearly going to need to exert his influence somewhere? And like that western border obviously is the area that historically has always been, you could argue, the biggest focus. Does this get greater or less in terms of the influence he's trying to push into these regions?
Look, Putin is a malign actor, that's clear, right? He invades countries, he intervenes in our elections, he does cyber attacks, he messes up with our cabling in the seas. He does everything to disrupt our systems of government, right? Whatever happens in Ukraine, the threat from Putin will remain as long as he's in office. And I think Europe is waking up that they have to get serious about their security. And obviously Trump has suggested he's not that willing to fund European security. You know, we have to spend more on defence.
How much? Do you have an idea in your mind as to how much money Europe needs to spend?
Well, we have to go back to where we were in the Cold War period, right? You know, pre-89-91. I mean, we were spending 3% of GDP plus. Right, so think NATO is struggling at the moment to get to the 2% defence target. You know, 3 to 4%. I mean, it's big numbers hundreds of billions of euros a year extra in defence, whatever happens, if we're serious about our own security, and I think we have to be.
So that's about physically protecting democracy, in the tech landscape, protecting democracy. I mean, the role of TikTok in what happened in Romania, really quite incredible, Tim. I mean, does this focus our attention once again on the use of those platforms in election meddling?
Well, it just underlines that, you know, modern warfare is complicated and asymmetric. Putin attacks us. You know, malign actors, you know, you could name them, attackers in various different forms. So we need to be cleverer. We're not very clever, unfortunately, at the moment, right? I mean, Putin's threats were obvious for a decade and a half. We did nothing about it. We didn't take it seriously. The Germans thought it was great to buy energy from the Russians. Many think tanks were clear-cut in the risk, and our politicians ignored it. We need to wake up and get real. Fortunately, it looks like we are. Maybe, hopefully it's not too late.
Time to reread the Clausewitz. Tim? Thank you very much indeed. Timothy Ash, Senior EM Sovereign Strategist at RBC Blue Bay Asset Management. Thank you very much indeed. Coming up, why the airline industry is expecting sky-high demand in 2025. My interview with the IATA Director General, Willie Walsh. That's next. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome back. So IATA says the global airline industry is set to earn $36.6 billion in net income in 2025, driven by a record 5.2 billion passengers. It's a little tick up from where we are this year? Are we plateauing? What's happening? Well, I spoke to IATA's Director General, Willie Walsh, on the lobby group's annual forecast. As well, we talked through his expectations for the incoming Trump administration and what impact that will have.
I think consolidation is a positive for the industry, and quite honestly, I believe it's a positive for consumers because, you know, you have an industry now in the US that's capable of investing in products that otherwise they wouldn't have been. If you think back 10, 15 years ago, the quality of the product in the US severely lagged the rest of the world. So consolidation will help, but it's not the only thing that needs to happen.
Do you think it'll be easier under a Trump presidency?
I think the indications are that it probably will. You know, I think the Spirit JetBlue merger probably would have gone ahead under a different administration. You know, when you look at the counterfactual, the fact that Spirit has now had to file for Chapter 11 demonstrates that you're not actually keeping competition in the market by preventing these mergers going ahead. Quite honestly, you risk losing competition in the market. So I'm hopeful that we'll see a different regulatory approach being adopted by the Trump administration.
You dedicate quite a lot of time in the report to the Trump presidency and the risks and rewards that exist coming from it. Which do you think is greater? How substantial are the risks surrounding this industry? We're spending a lot of time talking about tariffs at the moment. That could impact the supply chain story that you've already referenced. We've seen travel bans in the past. How significant a risk for global aviation, for US aviation, does the Trump presidency represent?
I actually think Trump presidency, based on what we've learned from the first administration, is a net positive. You know, there will be challenges and there will be opportunities. I expect them to adopt a completely different approach to regulation. I think what we've seen under the Biden administration was heavy and unnecessary regulation. Often, I think, for generating headlines rather than genuine consumer benefits. So I think that will change. I think the approach to oil production will assist with a lower oil price. So I think there are significant positives and, you know, some potential drawbacks. But if you learn anything from the first administration, I think you'd have to see it as a net positive for the industry.
What is job number one for Sean Duffy if he's been nominated, if he becomes Transport Secretary?
I think it would be to roll back on the heavy-handed regulation that we'd seen under the previous administration or the current administration. As I said, I think many of those regulations were introduced to generate headlines without seriously understanding what was the impact going to be on the industry or the benefit that was going to accrue to consumers. You know, we're optimistic that we'll see a more realistic approach to regulation. Regulation is important. You know, it has a role to play. But the answer to every problem is not to regulate it. The answer to the problem is to understand the cause of the problem. So the cause of delays in the US, principally because of air traffic control, and that's because they don't have sufficient air traffic controllers. You're not going to sort that out by regulating airlines because you're not addressing the actual underlying problem. So hopefully this incoming administration will address the problems and make it better for everybody.
Do you know the incoming commission will do the same thing in Europe?
Yeah, it's a great question. You know, I take a lot of comfort out of reading the Draghi report. I think that was a very positive development. I think it needed to be said, and I'm pleased that we now have a report that highlights the need for Europe to be concerned about their competitiveness on a global scale rather than fixated on competition within the single market. You know, we have seen a lot of regulation in Europe. It is very heavy-handed. It doesn't address the underlying problems. You know, I'm optimistic, actually, that the development with a new commission in Europe and a new administration in the US may lead to a more sensible regulatory environment.
IATA's Director General, Willie Walsh. So two things really going on in this industry right now, one of which is there's a massive supply chain problem. Boeing's got issues, Airbus has got issues, Pratt & Whitney's got issues, GE's got issues, Rolls-Royce has got issues. All of that is impacting the availability of new aircraft, which is going to make it really hard, by the way, to meet sustainability targets. And the other issue is just the massive regulations that surround this sector at the moment. Willie clearly sees a need to reduce that. How far will the Trump administration go in that process remains to be seen. He talks about making, when he nominated Sean Duffy to be Transport Secretary, he talks about making the flying experience in the United States better. Does that mean less regulation or more regulation? I don't know yet.
And does it mean some M&A? Because Willie Walsh seemed quite positive on what this means for lower regulation in the United States, also quite positive on what it means for M&A.
This is something that has bipartisan support, by the way. This is something that I think there were just hearings in Congress where Republican lawmakers had grilled some of the airline CEOs on check-in fees and when they were incentivizing, say, gate check attendants, for example, to actually bring in more because there's an actual physical incentive that they get when you check in a bag. At least that's what the grilling was in Congress. So that's something that not just Republicans are talking about, but Democrats as well.
If you talk to the airline bosses, they talk about the FAA. They need to staff up, particularly with air traffic control. It's a problem here in Europe as well, but it's a real problem in the States at some of the key airports. There isn't the sufficient level of staff, and that's where you're getting some of these huge delays that are kicking back through the system.
Sorry, I was going to say, in planes, trains and automobiles news?
I can go to buses as well.
There
it's not planes, trains and automobiles. I guess the automobiles
I can do anything.
I can tick all the boxes when it comes to the transport story. A little grounded maybe more on the buses story. So tonight is going to see the premiere of the latest episode of Bloomberg's Chief Future Officer series. In it, I speak to the CEO of Flix. Have we heard of Flix before?
CFO, yes.
CFO,
Flix, crucially, yes.
So this is a German tech transport company. There's a bus, there's a Flix bus. So what this company does is basically take its tech model, which is about ticketing and schedules and things like that, and then use local operators basically to feed into that system. And it's basically using it to take over the global long-distance bus market. Earlier this year, it issued an IPO. It's gone for private money, which is interesting, coming back to the theme that we've been talking about. So it took money from EQT, it took money from Kuhn Holdings in terms of driving itself forward. Anyway, that premiere a little bit later on in the United States tonight. You can see that tomorrow here in Europe at 6:30 p.m. London time. We'll maybe play some of the sound tomorrow. I know you guys are into the bus story.
Absolutely.
Long-distance buses.
Competition from long-distance buses with aviation. That sounds like it weighs on inflation, which takes us to our next conversation. I'm stretching slightly because this is over in the United States. But we are looking for inflation data out of the US later. Forecasters are expecting that the data will show a fourth straight month of firm increases in prices. Bloomberg's Valerie Teitel is here to tell us what we need to know. So it's all about this, the stickiness, I suppose, in a sense, of this inflation print now.
Yeah, the core CPI metric, a lot of eyes will be on that month-on-month. We could get 4 straight month readings in a row at that 0.3 metric, which is important because the 0.3 is going to take us farther away from the Fed's 2% target. And I thought it was really interesting that this print today has the smallest implied volatility in the equity market priced in, which goes to show either we've gotten way better at forecasting inflation or perhaps last week's payroll report really cements in that Fed cut next week. We will need a substantial hot reading on today's print, I think, to move the dial on today's Fed on next week's Fed meeting.
Today's print matter?
You know, that's a very good question.
We'll get PPI tomorrow, don't we? Which is where the PCE reading comes in, doesn't it? So maybe tomorrow we'll be talking about that. But I'll say it now in case we don't get time because it's the ECB.
I thought all we cared about was payrolls, and here we are saying we also don't care about inflation. We also don't care about all these other things. I don't know what the bond market trades off anymore. It's very confusing.
Look, it's going to trade very much off what we think about the new Trump presidency, and a lot of that is just full of questions and unknowns, especially what we heard from China just earlier today, that Reuters report talking about China is mulling a weaker currency. That is very much a reaction to very much a tit-for-tat tariff fight.
So the fiscal, potentially over the monetary, over in the United States. Valerie Teitel giving us a preview of that CPI data later today. A reminder that the U.S. Treasury Secretary Janet Yellen will be speaking exclusively with our very own David Gura. We have that interview at 3:30 p.m. London time as well. I believe that does it for the opening trade. The markets are a little bit mixed. You're seeing futures over in the States marginally higher. Emphasis on marginally. The Pulse is up next. A stellar lineup there as well. The market story continues. The countdown to the CPI story continues. European stocks in the red. Stick with us. The Pulse is up next. This is Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that The degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hi, I'm Laurie Haynes, CEO and co-founder of Shirar, and I'm really excited to tell you that we are going to be raising funds for Shirar again. After a successful raise in 2023, it's time to scale.
We hope that you enjoy the pitch deck and the financial model. Any questions, please don't hesitate to ask us, and we can't wait for you to be part of Shirar.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Flat, but this is where it gets interesting. I would not only look at offshore yuan, but also at the 10-year yield in the U.S. 4.2322 is at yield for treasuries, and you can see yuan 7.2815. S&P futures practically unchanged. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that the United States is weighing new sanctions against Russia's lucrative oil trade, looking to squeeze the Kremlin's war machine just weeks before Donald Trump returns to the White House. Now, in just a moment, we'll be joined to talk markets by Mira Chandan from JP Morgan. But first, let's focus on the White House with Ross Matheson, our Bloomberg News Director for the EMEA region. Ross, when you look at the timeline, I mean, we're going to have probably an interesting 4 weeks because we're less than 6 weeks from inauguration. So will the Biden administration push things through as much as they can?
Well, it's quite interesting to see that suddenly Joe Biden seems to feel emboldened to do things that people were urging him to do for years, and he was reluctant to do that for obvious reasons because of the risk to the oil market and oil prices in the US, but suddenly seems to be wanting to do. I mean, there's sort of blocking the US steel deal, deciding to fall in line with Donald Trump on that. But the question is, what is the practical reality of this? What's the practical application? And there's got to be a lot of questions about that. You can't imagine that Donald Trump is going to want to endorse measures that might have an impact on the oil price in the US. He doesn't want to have that coming in as he takes office. So this could be fairly short-lived, and it's very difficult to understand practically what the US might be talking about, because they don't import Russian oil at all. Are we talking about secondary moves against companies in China or India that have been buying a lot of stuff from Russia, for example? And how does that work, and how do you get that system up and running in a couple of weeks, potentially to have it be unwound shortly after Donald Trump takes office? So it's possibly a bit of a symbolic move by Biden more than anything else, but it lines up with the amount of weaponry he's trying to push heavily towards Ukraine. And it's again about maybe getting Ukraine in the strongest position and trying to weaken Russia as much as possible before there are talks about that war.
Roz, there's so much going on in the Middle East. Of course, we saw Syria over the last couple of days. There's extra strikes coming from Israel. How will Donald Trump deal with it when he comes into office?
Well, seemingly so far he doesn't want the US to be heavily involved, particularly in Syria, and definitely not on the ground beyond the US soldiers who are already there dealing with Islamic State. You can see that from the messaging from Donald Trump and from those around him in his inner circle before he takes office. It will be interesting to see what he might do with Israel on this. Does he allow Israel to take an even firmer hand directly against Iran, for example? He's done some signaling around that. Does he allow Israel to go more directly towards Iran with US support, potentially? We can see Israel really pushing into Syria, at least temporarily for now. They call it a defensive move, but we need to watch what happens closely there. He obviously wants the conflicts, in Gaza and Lebanon to come to a halt pretty quickly. Does he push for a ceasefire, along what the US administration's already been doing? But particularly interesting to see what he does to endorse Israel potentially in the region.
Roz, I mean, there's so much, I guess, that had to happen for Syria to see a change in leadership. What do we know about the rebels in charge? We're hearing conflicting stories about them wanting to then step back and give people the right to choose, but the fact that they're extremists as well.
Well, it's a different ballgame. You're talking about a group that's been a militant outfit, although kind of shadow running a government in Idlib for quite a bit of time. So they've had this sort of parallel administration in a way going on, and they're obviously trying to replicate that with a transitional government. So they put the same person in charge of that to try and keep the bureaucracy going, keep the lights on, and the country functioning. But again, you are kind of now becoming a political force in a way versus a military force. And how does Syria deal with that? How does the rest of the world deal with this outfit? Because they are considered terrorists by the US and others. Do you now have to engage them in some fashion, and what does that look like? And meanwhile, still those questions about vacuums in Syria. A lot of groups operating, potentially including Islamic State.
Thank you so much. Roz Matheson there, head, of course, of our EMEA news desk with everything that matters. Looking ahead to US CPI later today, forecasters are also expecting the data to show a fourth straight month of firm increases in prices. Now, for more, let's bring in Meera Chanda, co-head of Global FX Strategy at JP Morgan. Meera, we'll get onto data in a second, but because of all this geopolitical swings, I mean, it doesn't play out, of course, in FX. Does it hit, U.S. confidence at some point if things get worse, or do you just completely ignore it?
Markets ignoring it for now. I think it's hard to think that the U.S. will be completely immune, but I think the U.S. is going through a bit of a transformation itself. It's going to have a variety of domestic policy offsets. We're talking about deregulation. We're talking about potential corporate tax cuts, the TCJA cuts down the line. So I think there's still enough there that with everything that's going on in the world and a potential trade war in the pipeline, that actually, U.S. can be a bit more insulated. And certainly we're seeing that playing out in the dollar.
Yeah, and Meera, and you kind of see that. I mean, today's big inflation day. Of course, it'll give us an indication of what happens with Fed in December. But then are all bets off from January, given the potential of extra tariffs and trade wars?
Well, I think it's going to be a bit of a mixed bag. I think it's fair to say U.S. is extremely resilient as we speak. I mean, even the labor market, it is softening, but I think you could also argue that it's normalizing. And if you look at the variety of the survey measures that have come out, they've been reasonably positive. The growth data seems to be tracking okay, and the Fed's cut rates, and that should help. So all of that I think next year is going to have more uncertainty, but it's going to be a more uncertain world for countries outside of the U.S. The U.S. itself has a lot of insulating factors, and I think the dollar, the dollar can stay quite elevated, and in fact, I would argue should be even stronger in the first quarter with all the trade conflict in the pipeline. But a part of that narrative is that the Fed actually doesn't cut that deeply.
Yeah. So what are you expecting? A cut in December? One more cut?
Yeah, we're looking for a cut in December, and we're looking for 3 more cuts next year, down to 3.75 for the policy rate in the U.S. by the end of next year. But I think important to just point out that, the Fed is not alone in this cutting cycle. 80% of central banks are cutting rates, and actually the dollar will end up maintaining its yield dominance. Even by the end of next year, we're expecting it's going to yield more than 40% of the countries globally, which is a pretty big deal in an environment where the U.S. is also out-delivering on growth relative to other countries.
But you'll also have a president in charge who cares about dollar levels,
yes,
and will actually talk about dollar levels, yes, which is probably a very big break from the past. Does it? I mean, what can they do to lower dollar if it rallies too much?
Yeah, I think that's the single biggest question, and I think we should look at the Japan experience, and what we've learned from that is you can't really get a weaker currency unless the central bank's on board. Yeah. And I think that's why this issue of who the next Fed chair is going to be, how the Fed independent story evolves. There have been talks of shadow Fed chair, how that evolves. All of that is going to play into it. And so the way that we're expecting this is going to play out is you get a knee-jerk Q1 strengthening in the dollar, euro-dollar sub-parity, dollar CNH north of 750 in reaction to tariff talk. But beyond that, a lot of things could change, and one of the factors we would be watching is actually what happens with the Fed chair. I have to say, if you go back the last 4 decades, what we found is that the periods of largest dollar weakness happens to be when the Fed is cutting and U.S. term premium is going up, and maybe that's what's happened. You get more issuance, higher term premium, and the Fed easing, and that gives you your dollar weakness eventually.
Eventually. I mean, when you look at how do you play it in the medium term, in the short to medium term?
Yeah, I think the most amount of confidence we have is that the tariffs are in the pipeline, and it's dollar strength. We have been underweight euro and CNH. I think 2025 is going to be about the Japanification of the euro. I think even in our baseline, without any tariffs, if you had that baseline, euro would be one of the lowest yielding currencies globally. And if you get tariffs over and above that, that just solidifies it. So I would say just underweight euro across the board. And the Japanese yen, on the other hand, has a chance to bounce back. So I think particularly pairing that versus the Japanese yen is going to be quite interesting.
Mira, does the crypto czar at the White House change the financial institutions or how you look at some of the currencies?
Not necessarily. I mean, I think what we can say more globally is that we're going to enter into a period in which, fiscal spending is going up in the U.S., but it's also going to be going up everywhere globally. I mean, Europe will have to spend more, even if it's on defense spending. And I think to the extent, we know China is going to do more fiscal response as well in reaction to the trade conflict. So I think broadly speaking, if fiscal issuance is going up and central banks are cutting, then the interest in sort of the non-fiat currency alternatives do tend to go up. So gold is clearly a prime beneficiary for that. We're overweight gold, and I would say to the extent that various cryptocurrencies, hit that bucket for some parts of the investor base, I think that can hold up pretty well.
So interesting. We'll talk a little bit more about gold and also China next. Mira Chandan, co-head of Global FX Strategy at JP Morgan, stays with us. Now, we're just getting a little bit of breaking news crossing the Bloomberg terminal. HSBC examining plans that could cut costs by at least $3 billion as it continues to restructure its worldwide operations under the new chief executive, George Elidary. Now, this would represent a roughly 10% cut in the bank's expense bill, which this year is estimated to come in around $32.6 billion. That's according to figures compiled by Bloomberg. Coming up, Luigi Mangione, the man accused of murdering United Healthcare executive Brian Thompson, is fighting extradition from Pennsylvania to New York. So we'll also bring you more on that story next. But shortly after this, we talk about China and how to play yuan. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back, everyone. It's December. A lot of people are winding down. Not our reporting team. We just have a great Bloomberg scoop talking about the BOJ set to see little cost to wait for next rate hike. Now, this is according to people familiar with the story. And through our reporting, of course, on the ground, it seems that Bank of Japan officials see little cost to waiting while still being open to hike next week. And that would depend, of course, on data and market developments. Officials view this probably next rate hike as a matter of time with the economy and inflation in line with their projection. This is something that was confirmed by the people that our reporters on the ground spoke to. So still with us is Mira Chaddan, co-head of global FX strategy at JP Morgan. Mira, thank you so much for sticking around. I mean, we talked a lot about dollar. We mentioned euro. I mean, the Bank of Japan it did give us a lot to talk about in the last 12 months. I mean, this seems just like common sense what they're saying. Does it change any of your calls when it comes to yen?
No, not really. I think being constructive on yen is one of our key calls for next year. I don't think you can really pair the dollar versus the yen because the yield differential is just too wide. They're in completely different situations. But when you look at, I think the BOJ is primed to hike rates. By the way, the inflation, has went up. It stayed elevated. It's been consistent. It's been in line with their expectations. And actually, our economists have an out of consensus call for the BOJ to be hiking to 1% by the end of next year. And in fact, we are looking for a December hike as well. So this new story does confirm that. I would say dollar yen, we expected to have a shallow recovery, down to 148 or so. But the big move, I think the big story here comes back to between euro and yen. You get a fair amount of yield convergence where I think there is scope for the ECB terminal rate at 175 to catch down to that of the Bank of Japan. And Bank of Japan should be hiking to 1%. So this, I think, really is setting the groundwork for yen to be in a much better place of recovery for next year. Absolutely.
Mira, I know, when you look around the world, like where's the right time to deploy, I guess, money in FX right now? I don't know if there's opportunities in sterling because it's more of a stable government, or is there elsewhere that looks more immune than the volatile places?
Yeah, sure. I would say aside from the big currencies where, we would be underweight euro, underweight CNH, overweight yen. I would say there are a few smaller, high beta cyclical currencies which usually get a bit ignored, are trading quite cheap actually relative to history because they were low yielding currencies. Say Sweden and Norway. They look like, the last couple of years have been stark underperformers. I think have a lot of scope for recovery there. Sterling, I think has been one of the best performing currencies after the dollar, for most of this year. And for good reason, even though the macro prospects aren't particularly great, at the end of the day, the BOE is keeping rates high and the growth is managing to be positive. I think there are limits to how long that can go on. I mean, UK is not the US. It's more insulated from the trade war because it's a more services-oriented economy, and the trade war is going to more directly affect currencies that are heavily dependent on manufacturing, like the Eurozone or China. But I think equally, it's hard to get too excited about the prospects of sterling, given the outperformance it's had. And I would say that the Scandies probably represent more value at this point.
So interesting, Mira. Thank you so much for joining us today. That was Mira Chandan, co-head of Global FX Strategy at JP Morgan. Now, in other news, the suspect in the murder of the United Health Group CEO is fighting being sent to New York to face charges that potentially setting up a long legal process. Now, Luigi Mangione faced a court hearing in Pennsylvania where he was arrested on gun and fake ID charges. For more on this, let's bring in Bloomberg's Jill Dices. Jill, this is a story that's been gripping everyone over the last week. What explains this unexpected move to fight extradition to New York?
Yeah, so at this point, all we really know is that Luigi Mangione and his attorney, obviously he's currently being detained in Pennsylvania on these gun charges, but it's the second-degree murder charge that he faces in New York City that's obviously at the center of this case here. He's fighting this extradition case. Now, ultimately, he's likely not going to be successful, but there's a couple of explanations that we've heard from some experts that might give us some idea of why he's doing this. It could be that he's trying to find a lawyer still in New York, to help him on that case involving that second-degree murder charge. That's a charge that, carries a sentence if he's found guilty of, anywhere from 15 to 20 years to life in prison. He may be trying to avoid going to, New York's notorious Rikers prison at the moment. But ultimately, I mean, this really just kind of seems like it's delaying the inevitable here. The New York Governor Kathy Hochul has, called on Josh Shapiro, the governor of Pennsylvania, to help move him over. So ultimately, it does seem like at some point he will make his way to New York City, and we'll see where the case goes from there.
Jill, thanks so much. Jill Dice is there with the very latest, of course, on this pretty incredible story that we've been following all week. Now, coming up, more of our conversation with Google DeepMind's Chief Operating Officer on why no one should wait to use artificial intelligence. That's next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics politics to the world of business. Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We're seeing a lot in, first of all, my advice is always use it as quickly as you can. Start using this. Like, people are waiting and thinking they have time. You don't have time. So I think really leaning into the learning opportunity. So one thing I actually started doing was just asking my team members at all levels in the organization how they're using it. And I was really surprised and started to shine a spotlight on them and to spread it. So obviously we've had this technology in our hands for quite a while before we release it. But finding, the market analyst who is using this to quickly summarize some of the press reports and being then able to add her own expertise layered onto that. Our legal team, which gets so many inquiries, from even within the organization, and how they're using this as kind of an internal customer service. There's a lot around general productivity of what we're doing. And so I think even if you're not full-scale adopting it yet, starting to experiment, because you'll never have as much time and freedom to experiment as you do now. And it's a good chance to really kind of encourage folks to find new ways to make AI beneficial internally.
So what does this look like in 5 years? I mean, at DeepMind, does it mean, fewer lawyers, less accountants, less programmers, or more programmers?
Yeah, actually what we're doing is saying, where do we need the human expertise, that nuanced understanding, and really apply it more towards the frontier of the work, and how do we start automating or triaging some of the lower level work? As someone who, again, has kind of, we all kind of go through our careers. So the early stage, you want people to still have opportunities to learn. So we look at this as not necessarily replacing the human work that needs to be done, but rather augmenting and being able to scale.
Well, that's Google DeepMind Chief Operating Officer Laila Ibrahim speaking about the opportunities in artificial intelligence at our Bloomberg Money, Woman, and Power event. Now, coming up, the group head of Macquarie Asset Management on the key risks to financial markets next year, despite the favorable outlook for asset prices. We discuss that next, and this is Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. The dollar gains after a report that Chinese leaders are considering allowing the yuan to weaken as they brace for higher tariffs under a second Trump presidency, while investors await U.S. CPI ahead of the Fed decision next week. The U.S. weighs harsher sanctions on Russia's oil trade to tighten the squeeze on the Kremlin's war machine. Plus, HSBC's new chief executive eyes $3 billion in potential savings as it continues to restructure operations. Now, the latest U.S. CPI reading expected later today should, of course, give clues on whether the Fed will cut or hold rates next year. Inflation remains a key risk for next year, especially if there's an escalation in tariffs and trade conflicts. Well, that's the view of Macquarie Asset Management, which has released its 2025 outlook. Joining us to discuss all of this, Ben Way, the company's group head. Macquarie manages more than $580 billion in assets globally. Ben, so good to speak to you. We're looking forward to 2025. I mean, a lot can go wrong, but also there are a lot of opportunities out there. What's the best way to think about what the strategy to deploy cash next year should be?
Yeah, it's a great question and great to be here, Francine. So we're super positive about 2025. Okay. You know, we think the world is going to see very solid growth. We think policymakers have done a really good job of navigating a very difficult period out of COVID and then through a very fast rate hiking environment. And we think also with interest rates continuing to come down, that will just create more investment opportunities. So we're very positive. We're excited about the world. We do acknowledge that there will be more geopolitical upheaval. I think that's the world we just have to accept that we live in now. And so that will cause moments of short-term angst within the markets and more broadly in the investing community. But I think the big economies continue to be well-regulated. They are well-led, and they have real investment opportunities, whether it's in opportunistic real estate, whether it's in terms of things like infrastructure and so on. Those sorts of building blocks of the economy where there's still real unmet need and where private capital can play a real role, we see that right around the world. And it's not just in the most scale market like the US, but even markets that perhaps are in the news at the moment for, you know, less positive things like Korea. That's a market where we've been for 25 years. Markets like the UK, where we've been for 25 years. These are great markets that investors love, and they always present good opportunities.
Ben, I guess the concern is, you know, an inflation resurgent because of tariffs, trade war, and the race to the bottom. How do you account for that, given some of the chatter around, you know, potential Donald Trump policies?
Yeah. I think the first thing is we're a long-term investor. So, you know, everything we're thinking about is not on a 12-month or 18-month sort of window. So I'd say, you know, inflation comes and goes. I think if you find high-quality assets, particularly in, say, things like infrastructure, where you can really protect your cash flows because of the contractual nature of those assets over a long period of time, and then you can drive growth in those businesses, then you can unlock really good risk-return results for your clients. So I think, again, people need to take a medium-term view. I mean, the US is a great economy. It's been incredibly resilient. It's well set up. There may be some policy shifts as we move into January and a new administration that will cause some challenges that may be idiosyncratic to certain sectors, but it will also create new opportunities and vice versa. I mean, around the world, if we think about the trade war,
that's creating opportunities in terms of deglobalization. That creates opportunities in places like Mexico or Brazil. It creates opportunities in parts of Southeast Asia where trade might shift away. And so just as there will be challenges in some markets, there'll be significant opportunities in others.
But opportunities with an initial shock? I mean, if you look at Mexico, I mean, the market is expecting quite a lot of volatility. So when do you know the right entry point?
Well, I think that's the game of investing, right? We all want to enter the market. We all want to enter the market when we can buy cheaply and then sell at a much higher price later on. But do we believe that there is a long-term secular tailwind in terms of deglobalization around nearshoring and reshoring? I think we all think that. That just makes a lot of sense. If you're going to move supply chain or diversify your supply chain and you're the biggest economy in the world, you're going to do that in areas that are proximate and regions that are proximate to your own country. And so we don't think that trend, that tailwind will cease over the next 5 to 10 years. But will there be periods where perhaps we need to pause as investors and have more certainty around what is actually the policy direction? I think that is the case. And so I think what we do need to do, like with any administration in the new world, as they assemble the team and then they put in the policy, normally investing might pause for a period just to take a temperature check. And I think that's just being a responsible steward of capital.
Concretely, where do you see opportunities in the UK and Europe? I know you made an offer for Renewy. I mean, this is a dual-listed, London listing in Amsterdam. Are there any more like that you think presents a good deal?
Yeah, look, we think the UK remains a great place to deploy capital. We've invested more than £60 billion here over more than the last 15 to 20 years, and we have recently made a commitment to deploy £20 billion over the medium, £20 billion, I should say, over the medium term. So, again, things like transport, energy, the digital economy, all those areas, both whether you be in the UK, Germany, Spain, France, we see those markets as attractive. I think it comes down to, what is the particular need in that market and how does that link into these broader global tailwinds. But if we look at things like digital infrastructure, the opportunity to not just to continue to support things like data centers and fiber, but also think about how we match that with energy, given the rapacious appetite of things like data centers, particularly because of the AI boom. That's an opportunity all around the world, but particularly here in places with Europe where you've got really good policy, very responsible policy about, yes, we want to take advantage of generative AI, but we don't want to do it at the expense of not being able to power our communities. And so our job is to come up with solutions for that.
Is the UK more attractive than, for example, in Germany? We saw M&A in the UK increase by 85%. What's supporting that?
Yeah, look, I do think, I think it was valuations, to be honest. I think valuations have been relatively muted here in the UK, and I think people see this as a very well-regulated market. I think investors have had a very good experience over a long period of time. And so I think you, first of all, got the opportunity to deploy large amounts of capital in the UK into a market that you know well. And so when valuations were a little bit more muted, perhaps because of political change or overhang, then people have taken advantage of that. And so, yeah, we would expect to see in Europe, but including in the UK, more M&A, particularly in a more positive year next year.
Do you see more infrastructure deals to be done in this region, and do Trump policies help with that?
Look, I think around the world, infrastructure is having its time in the sun. I think both as an asset class, it's never been more supported by institutional and wealth investors than it is today. That's the first thing. And secondly, given where a lot of government balance sheets are, the need to upgrade, recycle assets, but also to build new capacity, clearly we need to unlock private capital, and it needs to work with corporate stakeholders, but also community stakeholders and government. So I think that's a trend around the world. Right. And I think here in Europe and the UK, given the balance sheet positions of a lot of governments and given the fact that need to invest and upgrade infrastructure, that will continue to create opportunities. And I think the big economies across this region will continue to present the biggest opportunities just by the nature of their economy and how significant their asset bases are.
I know you've also been looking at infrastructure assets in the Gulf. Yes. Again, if Donald Trump's trying to reshore more business, does it depress valuations in the Gulf, in Europe, that therefore make it more attractive for you to come in, or is it uncertain?
Well, it depends what sector it is, because it is a good question, because a lot of infrastructure is local. It services local economies. And so it really will depend. So I think you could make the argument that, you know, if you're in transport, for example, and you're in ports, depending on where trade flows shift, that can both increase or decrease values. So you can take advantage of that and be geared to the upside and take advantage of that diversification. Again, equally, if depending on the market and who you're serving, that could be a negative. So I think, again, you've got to look at it in that way. I think if we think about the Gulf or the Middle East, you know, I think, again, that is going through a period of growth. There's very strong government policy supporting private investment to really put in the building blocks to diversify those economies, to move them beyond just energy. I think that's exciting. I think it's exciting for the local economies, because I think when you spend time there, the pace of change has been amazing, but there's clearly opportunities to continue to invest to allow things like the service economies, tourism and other things to really explode there, and that needs better airports, it needs better roads, it needs better rail networks, and all the other sorts of infrastructure type businesses that support that diversification of economy. And so, whereas trade might slow down, I think you see economies respond by stimulating and focusing on their more domestic consumption economies, and that too creates opportunity. So it really depends on the sector.
Okay, thank you so much for coming on today. Ben Way, Group Head of Macquarie Asset Management. So I hope it's not the last time you come on, because there's a lot to talk about in infrastructure. Coming up, Bloomberg Economics has also been running the numbers over Donald Trump's protectionist policies, saying they could have significant implications for the global economy. So we'll get the details next. This is Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Well, trade policy from President-elect Donald Trump are set to test economic resilience around the world. According to the latest outlook from Bloomberg Economics, global growth will hit 3.1% next year. Now, that's unchanged from 2024, while U.S. growth is expected to drop below 2%. Well, for more, let's bring in Jamie Rush, our chief Europe economist. Jamie, I'm so happy to have you because we're trying to figure out exactly what the end game of this means for the world economy. So we're just a month away from the new administration. What are you expecting?
Well, I guess the key point is that people tend to campaign in poetry and then govern in prose, don't they? So, like, not everything that Trump has said on the campaign trail is nailed on for trade. So I think, well, our US team have articulated a view where they can think of 3 reasons why things might be a little bit more moderate than the worst possible outcomes. 1, the administration itself. We have some faces in there which are moderate voices, playing counter to the hawks on the administration. So I think that's one reason to think it. If you look at the Trump 1.0 playbook, it was actually extremely carefully constructed and calculated, right? They didn't just put massive tariffs on consumer goods, which push up inflation. They were very targeted on intermediate goods, so it kind of spreads the costs across the whole economy, limiting the inflation impact. And we'd expect more of the same, frankly. So targeted measures, targeted tariffs that minimize the disruption. And then finally, 6% tariffs. They would basically destroy bilateral trade between China and the US, create the supply chains for some of the biggest companies based in America. Waking up the next morning after an announcement to discover the stock market's tanked would be a reason to reverse course. So I think there's a few reasons to think that they will be moderate, and therefore the impacts on the global economy will be modest.
Jay, what happens to inflation?
Well, it totally depends on how far he goes. If he goes very, very far and moves out of that intermediate consumption, intermediate goods towards basically things like iPads, the things we all buy that are direct consumer goods. I mean, there's nothing between us and the exporter in China. There's just that you'll have to face the whole cost of the tariff. So it depends how far he goes. And if he goes far into consumer goods, then yeah, there will eventually be an inflationary price to pay.
What can you tell us about France and Germany? I mean, these are the 2 big ones. We're still waiting for a prime minister in France, and then we have German elections come February.
Well, like a political void at the heart of Europe is not particularly what you want to see when the difficult things coming down the pipe. I mean, the point is that both in France's case and in Germany's case, having a new stable government won't happen until probably the middle of next year, maybe much later than that. And there are decisions to be taken in the interim. I mean, we all know that the broad outlook for Germany is pretty grim, and we think that a lot of the weakness that we see there is structural. It's not coming back. It's energy. It's Chinese demand. There are big problems to tackle, so good luck to them.
Yeah, Jamie, thank you so much. Good luck indeed. Jamie Rush there from our Bloomberg economics team. Now, to a Bloomberg scoop now, NATO plans to assign new concrete targets for how many more tanks, planes, and other weapon systems member countries need to produce, which may require raising the alliance's defense spending goal to as much as 3% of gross domestic product. Now, that's according to officials familiar with the matter. So let's bring in Bloomberg's Andrea Palosciano. Andrea, thank you so much. We want to talk a lot more about, of course, this Bloomberg scoop. What can you tell us about, how that pits European countries against the U.S.?
So we had seen this coming. The new Secretary General had been repeatedly saying that the current 2% spending target was not enough. So while this is not a full surprise, this comes very soon after he first took office. And we know that Donald Trump has repeatedly pushed in his first presidency his European allies within NATO to spend more. And they have. So compared to a few years ago, a lot more NATO countries are reaching the 2% spending target. So if the target now were to be raised again, that would probably be rather well received in the U.S.
So, Andrea, at the moment, how much does it change, the system according to now? Does this stick Europe together, closer together, or are they worried about it breaking apart, and so they're trying to put this lockstep, this in stone?
So right now there is a bit of discrepancy within Europe between the biggest spenders like Poland, for example, who spend more than 4%. This year they have pledged 4.7% of their GDP on defense. And then other countries, such as the biggest spenders on Ukraine, for example, Germany, they barely reached the 2%. They are 2.1% this year. So this is likely to ruffle some feathers within the European countries of NATO. But ultimately, this is in line with the current trend in Europe, that there is an awakening and an understanding that a lot more needs to be spent on defense. And that is also true within the EU, not just at NATO. So ultimately, this is the direction things are going.
Andrea, thanks so much. Andrea Palosciano there with, of course, this extremely important Bloomberg scoop. Now, France's president is said to be working on piecing together a coalition of moderates to govern until his term ends in 2027. We're told Emmanuel Macron wants to free the government from the stranglehold of the National Rally Party, Marine Le Pen. Now, he's also expected to name a new prime minister within 48 hours after Michel Barnier was toppled in a no-confidence motion last week. Coming up, London's IPO market keeps shrinking. Find out why when we return.
Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Listen, I'm not a big fan of common debt. I think you're facing challenges concerning debt. I think we should put our government finances in order, and at the same time, we have to invest more in defense. That I agree on. But in order to invest more in defense, you have to find the room in your own budgets. So that's the message I echo here also in the European meetings. So get your finance in order, make tough choices within your budget, and spend more on defense. And I think common debt is not the right approach.
Well, that was the Dutch Finance Minister Elko Heijnen. Now, HSBC examining plans that could cut costs by at least $3 billion as it continues to restructure its worldwide operations under the new chief executive, George El-Hedary. Now, this would represent a roughly 10% cut in the bank's expense bill, which this year is actually estimated to come in at around $32.6 billion. That's according to figures compiled by Bloomberg, of course. What else? Now, Inditex shares tumbling this morning. That's after the owner of Zara reported slower sales growth at the start of the crucial holiday shopping season. Now, the Spain-based retailer said revenue excluding currency swings grew 9% in the 5 weeks to December 9th, compared with 14% a year earlier. Now, onto our big story, and London's IPO market has declined 9% this year, with only $1 billion raised, pushing the UK to the 20th place in global IPO rankings. It's been leapfrogged by upstarts, including Oman, a market that's just 1% of the size of the UK, as well as Malaysia and Luxembourg. So for more on all of this, let's get more from Bloomberg's city editor, Catherine Griffiths. Catherine, I mean, we knew that it wasn't going great. We knew that London was struggling. I mean, when you compare it to Oman or even Luxembourg, it's kind of like, your jaw drops. What's happening?
Yes, it's a sad and woeful Christmas, probably, for the London Stock Exchange. I suppose in some of those markets, they've had certain lumpy deals which have kind of pushed them up the rankings slightly. But you can't get away from the fact that the decline has been pretty terrible here in London. And I think we know the themes, and at least people are talking about the themes probably for the last few years, and that's this enormous sort of outflow, structural outflow of money from pension funds in particular, but also probably a confidence thing, a sense that if something kind of noteworthy and interesting came to London, it might slightly turn the tide, and a feeling that London still has all sorts of things that capital markets wants. It's got obviously huge financial services, legal expertise, so those things all exist, but there just aren't the people there with the money prepared to put it into the London Stock Exchange.
Does that change in 2025?
In 2025, I suppose, actually, I once heard one of the entrepreneurs who has said they might list elsewhere say off the record that it's like a tree. You've got to grow the things that are required. So you need more liquidity, but it doesn't just turn on overnight, of course. So you've got to have risk appetite, you've got to have structural change, you've probably got to have a sort of a public debate about risk, all sorts of things.
So who's the biggest competition for London for IPOs?
Well, I mean, US, isn't it? Yeah. Just straightforwardly. I mean, I guess, of course, other markets too, like Amsterdam, or indeed these other markets in Asia and elsewhere, which are clearly attracting some IPOs. But it's always the US, really, that's the big competitor. And, of course, London can't compete with its size and its breadth. But there are certainly things London can do, like this point about lots of sort of mid-market companies here being taken over, and one of the issues there being they're unloved, they don't have lots of analyst research, so investors don't particularly want to put their money into it. That's meant to be being addressed, but it hasn't been yet.
And this is, I mean, do we know if the government is like taking this on board? They made a huge deal in the run-up to the election of being business friendly. Is it still on their priority list?
I mean, I think it is on their priority list, but their priority list has kind of gone pear-shaped in many different ways, I suppose. But they do seem to realise that it's key to kind of achieving this growth agenda that they keep talking about. We have seen some capital markets reforms, some listing reforms. Possibly they will sort of feed through. And obviously there are big things potentially coming, like the big listing potentially of Shein in the UK, which isn't a sort of UK government-related thing. But there being the right supportive noises around that could help it actually get away.
Shein is a whole other, issue that we've talked about in the podcast, so we'll have to get you back on to talk about it some more. Bloomberg City Editor Catherine Griffiths. Now, later today, of course, we also speak to the U.S. Treasury Secretary, Janet Yellen. This is Bloomberg.
biggest risk in property and casualty is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is The Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Craney. Welcome to Bloomberg Brief. Let's set that agenda. Market calm ahead of the last CPI before the Fed decision, looking at a fourth month of firm gains in prices. FX volatility this morning on the rise. BOJ sees little cost to waiting for rate hikes. China is said to be mulling a yuan devaluation. And President-elect Trump picks Andrew Ferguson as the chair of the FTC to replace Lina Khan. Good morning. There's an uneasy calm, uneasy hesitancy, depends which word you want to choose, ahead of the CPI today. Julian and Emmanuel will be with us a little bit later on. Evercore say you've got exuberance rising, but there's a risk of exuberant corrections. Bank of America say we're underpricing the CPI reaction function today in markets. Roll it over, have a look at the bond markets, because we are looking for a plus 0.3% for a fourth consecutive month. Stubborn CPI, what does it mean for PCE? We will ask UBS. By the way, bond traders, JP Morgan have got their survey out. They're trimming their long bets. We're at neutral versus the strongest long bias of 2024. And we mentioned foreign exchange in the headlines. Let me just show you one day's volatility in dollar yen. I love it. The BOJ, it's a Bloomberg scoop. BOJ sees little cost in waiting for the next rate hike. We can wait to January or a little bit longer. There'll be no huge cost. Of course, we get the Tankan on Friday. We're also keeping an eye on these stocks. This is what's on our radar. U.S. steel, it fell over 9% at the close. That's after the news that President Biden has plans to formally block its $14.1 billion deal with Nippon Steel. GM, Mary Barra, has a lot to contend with. She is she's made an announcement that they're shutting down the robo-taxi business, citing the high costs to develop the technology. And Macy's falling pre-market. We're preparing for the report. Those results will become before the bell. We'll give you a little bit of a preview. And in just a few moments, Abigail Watt of UBS will join me to discuss CPI. Later in the hour, as I say, Julian Emmanuel. We'll talk markets with him from Evercore ISI. So we're counting down to this CPI data. It'll provide the latest hint on what the Federal Reserve may do at their next meeting. Here's what Governor Chris Waller had to say a little bit earlier this month.
At present, I lean towards supporting
a cut to the policy rate at our December meeting. But that decision will depend on whether data that we receive before then surprises to the upside and alters my forecast for the path of inflation.
Joining me now is Abigail Watt, UBS economist. Abigail, good to have you with me this morning. We have an issue around the pace of disinflation. How stubborn is it, and has disinflation stalled? If we look at the CPI number, we're expecting plus 0.3% for the fourth month in a row.
Yeah, so I think, we had expected to see some stickiness into the end of the year in the inflation data. This is something that we'd been anticipating, and we actually have an above consensus expectation for the CPI print this week. So our expectation is that we see core and headline both coming in at around 31 basis points today. I think the key thing to note, though, is for the FOMC, it's not just the kind of level that we see, but also the kind of composition of what's driving that inflation. And as well as that, I think the other thing to note is the importance of kind of the other inflation data that we'll get throughout this week, both the PPI and the import prices, because those will also inform our expectations for PCE prices. Now, obviously, the FOMC is targeting PCE. Now, our expectation is that we actually see the wedge between CPI and PCE kind of widening a little bit this month, despite our expectations for kind of core CPI to come in a little bit stronger. We still see core PCE prices kind of stepping down in November. So we're currently tracking a 19 basis point increase in core PCE prices, which would be a step down from the 27 basis points that we saw in October. And I think it's important to kind of make that distinction that we need to kind of look at the kind of both the composition of the CPI data today, but also kind of what the translation to kind of PCE prices will be off the back of the data.
So that PCE, obviously leaning into the PCE post the CPI, is where Chris Waller potentially will be a little bit more focused. He said he's still leaning towards a cut. That PCE data, that makes it justifiable to cut in December in your view and then pause?
Yeah, so our expectations are that we do see them deliver a 25 basis point cut at the meeting next week. Obviously, I think it depends kind of, again, where we see the surprises in the potential for the kind of CPI print today. We're expecting to see actually, and I think this is an interesting element of our forecast, we are still expecting to see kind of a step down in owner equivalent rents. And I think that is one of the components, obviously, that we've kind of heard the FOMC have been looking at in terms of that kind of inflation stickiness and the path ahead for inflation. Now, our expectation is, as you said, we think that they'll cut next week and they'll potentially kind of pause at their January meeting. And that's because we see kind of them looking at a kind of core PCE annual number of around 2.9% as they go into that January meeting. And that's where we think they'll potentially kind of deliver that kind of pause. And I think that the key thing to note, though, is that even with this stickiness and inflation kind of into the end of the year, our expectation is that we do begin to see kind of further progress as we move into kind of Q1 next year. And that's because the monthly prints, we think, will kind of lap lower relative to the monthly prints that we had at the beginning of this year. We still think you'll see the kind of usual seasonal pickup in kind of January and February with kind of annual price resetting taking place at the beginning of the year. But we do think that the kind of year-over-year rates will begin to kind of move lower. And with that, we think that they'd be back on track to kind of deliver another 25 basis point cut by the March meeting.
Okay, and part of this narrative is about whether we see a shift in productivity. Let's just listen to my guest from yesterday from Peel Hunt, Callum Pickering, on reflecting on the 1990s and maybe what we get for productivity right now. Let's take a listen.
What I think we've got here in the US is a strong productivity upswing, which is helping to bring price disinflation down and keep it under control. We had something very similar in the 1990s. Greenspan didn't raise interest rates into an upswing. Why? Because he saw that productivity was strong on the underside. So I think that's the story with productivity. What makes me much more nervous is US 7% deficit. That's a problem. What happens if, for whatever reason, you get a business cycle downturn and you get some unemployment? And what happens if the good news priced into markets just doesn't play out?
Now, you could argue we've got a lot of good news priced into these markets and everybody's worried about the deficit, but let's just reflect on that. How much of a believer are you and the team at UBS in this paradigm shift in productivity? Because it's integral to the inflation and the disinflation narrative, isn't it?
Yeah, so I mean, I think it's a very challenging thing in real time to see in the data. You know, I think being able to see kind of the potential impact from kind of AI, for example, some of these kind of big technological changes in real time is a very challenging thing to see. And actually capturing productivity itself is quite a challenging thing to measure. But I think as well as kind of productivity, the other thing that's important is the kind of change in population growth. And that has been, I think, one of the kind of key drivers in terms of the ability for us to continue to see the disinflation progress that we have seen in the US, despite the fact that we've seen the economy kind of running above trend. I do think that's one of the kind of key elements here is kind of what we see happening in terms of population growth. And obviously that feeds into people's estimates of kind of where potential is too. We actually kind of marked down our expectations for population growth in our latest outlook. And that's largely because of kind of some of the kind of potential changes with the kind of new administration around immigration. I do think that's kind of going to be an important factor kind of as we go into the kind of next year and the coming years in terms of kind of potential growth is kind of what we see happening in terms of the kind of population growth side of the economy.
Abby, thank you very much. Abigail Watt there of UBS, setting the agenda for CPI a little bit later on today. Good to see you today, Abby. Other stories trending on your Bloomberg terminal this morning. HSB plans to cut costs by at least $3 billion as all part of the restructuring under the new CEO. Reductions to senior staffers are expected to axe a little over 40% of the company's top 175 managers. A spokesperson for HSBC declined to comment. SpaceX and its investors have agreed to purchase as much as $1.25 billion of insider shares in a transaction valuing Elon Musk's rocket and satellite maker at about $350 billion. The per-share price, $185, is up substantially from the $112 set in a prior valuation less than 3 months ago, and cements the status as the most valuable private startup in the world. President Macron is seeking to name a new premier within 48 hours and is meeting with the major parties to form a cabinet. He's looking to form a coalition of moderates to avoid new legislative election and free his government from the influence of National Rally leader Marine Le Pen. Coming up, Lina Khan's days at the FTC, they're ticking down. President-elect Donald Trump picks her replacement. More on who that is on Bloomberg Brief.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Today, Janet Yellen, the first woman to head the U.S. Treasury, sits down for an exclusive interview with Bloomberg's David Gura as she prepares to leave office. Tune in today at 10:30 Eastern Time, only on Bloomberg.
Lena Khan seems to have missed the entire economic section in her college experience, because the role that she played in really reducing and eroding American productivity was profound. So I think that for the United States, all these issues around tariffs and this and that, how much are we going to drill? It's all second order. First order, we're back to business.
That was the Citadel founder, Ken Griffin, speaking at the New York Times Deal Book Summit a little bit earlier this month on Lena Khan, who, of course, heads the FTC. We're less than 6 weeks before President-elect Donald Trump, I should say, re-enters the White House. And he's tapped Andrew Ferguson to chair the FTC. Trump wrote on Truth Social this: Andrew has a proven record standing up to big tech censorship, protecting the freedom of speech in our great country. Andrew will be the most America First, most and pro-innovation FTC chair in our country's history. For more, let's get to Kate Ferguson. She joins us now to bring us up to speed. So, Kate Ackley, look, Andrew Ferguson, what are we going to get that's going to be so different to Lena Khan in terms of the approach? You heard Ken Griffin, a pretty damning assessment of Lena Khan and what she did to American business during her tenure.
Well, thanks for having me. Good morning. Yes, Lena Khan has been a real sort of thorn in the side of the business world, even as she's had some, words of support from some Republicans on Capitol Hill, including Vice President-elect J.D. Vance has said sort of flattering things about her. But it does look like this signals a shift in the agency's direction toward business, which is not a surprise. I mean, we've seen a lot of these picks have business and industry backgrounds. Ferguson has talked tough on big tech. In that way is like Lena Khan a bit. He sounds a lot like Elon Musk, taking the free speech aspect of big tech and like you said about the censorship. But I think overall, we would expect to see, and the business world is expecting to see, a lighter touch from him as chair.
Yeah, well, I think on Twitter he said, at the FTC, we will end big tech's vendetta against competition and free speech. And everybody's so bulled up that there's going to be more tech deals and exits next year. Let's talk about the Biden administration. We're counting down. There's 40 days left of this administration. And they're weighing new sanctions against Russian oil. I mean, a great deal was made, Kate, wasn't it, of this price cap. There was a lot of prevarication the first time around. But oil and gas prices were much higher. Why does Biden feel the need to move more harshly and more aggressively now? It's almost as if he's emboldened in these last dying days of his administration.
Right, he doesn't have a lot to lose. I mean, he's not setting the stage for his picked successor. He's not, returning to the White House. He'll be gone in about 40 days, as you said. So there's not a lot to lose, and it's seen as this could be the opportunity, these final days of the Biden administration, to really put the squeeze on Putin. And you mentioned gas prices are pretty low right now, relatively, and it isn't like it was in the run-up to the election, where there was a concern about gas prices and the sense that goods were very expensive, inflation was high. So you don't have those considerations right now for the Biden team.
No, and certainly the proposition will be is whether it's as harsh on Russia as it was on Iran, and that will have flow consequences for the oil market. Talk to me about Nippon Steel. It looks as if the president is about to block this deal. There've been ongoing discussions between Nippon Steel and the unions. The unions, they just won't budge. They just don't believe that this deal is good for their workers, do they?
No, and it's been a huge lobbying fight. Both of these companies have hired up some of the top lobbying firms in Washington to push their case, to try to, ease this deal. It hasn't seemed to work. And, if you look ahead to the next administration, President-elect Donald Trump has said that he also opposes the deal. Now, people can change their minds, who knows, but it doesn't seem like the change of administration would lead to a different outcome either.
No. Kate, thank you so much. Kate Ackley there on the very latest political stories making news headlines on Bloomberg Brief. Coming up in the show, the yuan is sliding after a report that China may allow the currency to weaken next year, but just how much will they allow the currency off the leash? Context matters on Bloomberg.
You missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Menace Cranny in New York. The front pages from around the world. These are the main headlines. First up, the New York Times leads with Syria's new leaders vowing to punish officials from the previous regime. The Rebel Alliance are looking to hunt down and discipline those who are implicated in the torture and other abuses. The announcement comes at a time when foreign powers are fighting for advantage in the country. Next up, Washington Post. A judge has rejected the sale of InfoWars, the satirical news site The Onion. The decision means conspiracy theorist Alex Jones could maintain control over the website, and another bidder could acquire the assets. Jones was forced to sell the platform to help pay roughly $1.5 billion in damages that he owes to the families of the victims of Sandy Hook Elementary School shooting, which he called a hoax. And Bloomberg leads with a foreign exchange story. The yuan, it falls after the report that China is weighing a weakening of the currency in 2025. Now, this would be a response to any potential trade war the United States may well launch. For more on the story, we're joined by Van Ram. The question goes through my mind, Van, is to what extent would they allow the currency to depreciate with the same velocity as they did in 2018, 620 to 720? Is that on the books?
Well, I think that is on the books, though on a milder scale, I would think, and a more gradual scale. I think that's the more important thing, because, you know, what China doesn't want is a flight of capital from the country, which they are already preoccupied with. So they want a weakening of the currency because, you know, of the three pillars of the economy, the property market, the consumption, and exports, it's exports that they need to fall back on the most, and for that they need a weaker yuan. So there is no question that they need a weaker yuan, but how they get to that lower target is the question, and they will do it gradually. It's going to be a drip feed. It's going to be watching the paint dry, because you're looking for excitement. It's not going to come from China's policymakers. If you look at the reference rate, Manus, this year, they've lowered it by just 1.5%. That's like almost baby steps. So they're probably saying we could go slightly faster from that. That's the message that I'm getting today. And let's see how it goes from here.
Brilliant. It's going to be like watching paint dry. So I'm not in for the rough and tumble in the yuan that I maybe had before. But here's the point. It's about the calibration of response. And the relationship, the import relationship with the United States is fundamentally different to it was during Trump 1.
Yeah, absolutely. I mean, they are now more reliant on, because of friendshoring and all those things that have taken place since the 2020 COVID situation. The situation on the reality on the ground is vastly different. Here is an economy that is now in deflation, which wasn't the case back then. So the economy is sputtering as it is. And if the Trump tariffs come on top of that, it will obviously have a huge effect on China's economy that is already grappling with deflation. So they need a weaker currency to a much more material extent than they did in 2018, Manus.
It's interesting because it depends which notes you read. JP Morgan say get ready for it. They're calling it drop. They're called bracing for a storm. They're calling for a 10 to 15% drop, not like the paint drying that you're saying we're going to get, Ven. From the policy rhetoric that you've seen this week, the Politburo, one of the biggest policy pivots since 2011, moderately loose and proactive fiscal response. But is that enough to undershore or shore up domestic demand? Because that's the key.
Domestic demand is the key, but Chinese consumers are not traditionally spenders; they are savers. So the first step of the recovery, Manus, has to come from the export side. And when I talk about currency gradual moves, I don't think that we are looking at a 15% depreciation. I think China would shudder to think of depreciation on that scale. But we are talking about 3 to 5% from here, albeit in gradual measured steps. And I think 5% depreciation from here is definitely what they need to get the economy to out of deflation and into the good export growth. I mean, back 10 years ago, we used to get double-digit export growth every month, pretty much every month. Now, gone are those days completely. Even if they can't revive that old magic, they need to restore some of it. And they need a weaker yuan for that, and a materially weaker yuan, although it will be in gradual measured steps.
Okay, well, they want to do it without spooking the financial horses and that capital flight. Ben, thank you so much. Ben Ram there of Bloomberg on the potential policy reaction from the Chinese. I'll give you the snapshot of the foreign exchange boards this morning. This is what we've got for you. Their sort of bigger move is on dollar-yen, as the narrative there is that, well, you know what, we can afford to wait. There's no great haste. They see little cost in waiting to hike rates. We're going to catch up with Julian Emmanuel from Evercore on equity markets. This is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From our global headquarters in New York, I'm Menace Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Market calm ahead of the last CPI before the Fed decision, looking at a 4th month of firm gains in prices. FX volatility on the rise. BOJ sees little cost to waiting for rate hikes. China is mulling a yuan devaluation. And President-elect Trump picks Andrew Ferguson as the chair of the FTC to replace Lina Khan. Good morning. There is an uneasy calm in these equity markets. What is your risk going into today? You're seriously underpriced in the reaction function, according to the Bank of America, in regards to this CPI. We're flat on equity. 6,050 is where we stand at the moment. We'll talk to Julian Emmanuel in just a moment from Evercore. Exuberance is rising. Your risk is an exuberant correction. What could provoke that? Maybe the bond market. Have a look at the bonds. Core CPI, we're looking for plus 0.3% for a 4th month in a row. Flat, 423 is where we are. By the way, would you buy 10-year bonds in an auction today ahead of CPI, PCE, and a Fed decision? They rolled up for the other auctions earlier in the week. The bond survey is out from JP Morgan. They're neutral. The long bias has dissipated. Snapshot of the FX markets. This is what's going on in dollar-yen. We have a nuance from the Japanese. They see little cost in waiting. It's a Bloomberg scoop on the Bank of Japan. Sees little cost in waiting for the next rate hike. Could be January, could be a little bit later. Anyway, either way, it says strengthened the dollar and weakened the yen. We're 3 hours away from the November CPI data hitting the tape. Let's get into the details. Mike McKee is with us. Mike, the headline is plus 0.3% on the core, 4th month in a row. It's sticky, it's intransigent, but is that the most important part of this conversation?
Well, that's the most important part of the conversation is what is the conversation at this point for the Fed? You're right, it's been sticky, and we've seen a lot of acknowledgement of that from Fed officials. We're well above the 2% target still, and they have pledged to push that down, but do they continue making progress, or do they need to keep their foot on the brake a little bit longer and maybe pause in December? You can see we're quite a ways still from that target, and the issue now today is going to be out to 3 digits. Is it getting worse, or is it getting better? 3/10 on an unrounded basis would be the highest in 7 months. So Fed is going to be watching this closely.
Do you think that trumps the unemployment data? I mean, Friday week ago we were doing the unemployment data, and it was an unemployment rate ticking up to 4.2%. And Mohamed El-Arian said, look, that is what will drive the calibration of a rate cut in December.
It's both. It was a high 4.2. You almost rounded to 4.3. So we'll look at the core today and see if that rounds to 4.3 as well. The headline forecast is for 0.3 and the core for 0.3, but neither has breached that number yet. They've been 2.8 for core last month. We'll see if we get above that today. And if that gives any signals to people about where the Fed might be, they're kind of divided over what they should do next.
The translation will be, of course, to PCE, but just a conversation with the economist from UBS saying that the wedge between the two, they still see a dissipation in the PCE, and that will allow the Fed to continue their cutting cycle.
Well, we'll find out over the next 2 days, particularly tomorrow when we get PPI numbers, because more of those, especially for healthcare, go into the overall PCE numbers. Plus, the CPI is distorted by the way housing is measured. It's a much bigger weight in the CPI than the PCE. And if you look at, and I'll just do this advertisement here, the ECAN function on Bloomberg, and you take apart where the inflation is in CPI, it's basically been in housing. That's the part that doesn't come down that the Fed's waiting for. So I'm not sure we're going to get any progress on that today, but until we do, you're still going to have problems getting closer to 2.
Okay, I'm going to start working analysis now on your ECAN function. Mike, thank you very much. Setting this up for the CPI. Mike and the surveillance team will bring you through that data a little bit later on this morning. My guest is Julian Emanuel, Senior Managing Director of Equity Derivatives and Quantitative Strategy over at Evercore ISI. Good morning to you. How are you?
Good morning.
So, spoiler alert, Mike just talked about owner equivalent rent. I've got UBS saying to me, nobody pays owner's equivalent rent, but we've got sticky inflation.
We do, and I have 2 sons that rent apartments in New York City, and I can tell you, it's sticky. And if you think about it, right, there have been 2 sort of material setbacks during 2024. The one was July and August, when the Bank of Japan ill-timed its last rate hike. Yeah. Clearly, that's not going to be a problem this time around into a weak employment report. But the other one was back in April, when the perception was that inflation was sticky for several months in a row. Back then, clearly the downward path of inflation began anew as you got further on into the year. But we're again at this point where the perception is there's stickiness, and do you end up getting, in fact, a hawkish cut at the December 18th meeting? And all of those, in our mind, are near-term risks to a market that's run a very long way.
We are building a consensus towards a hawkish cut, though, in December. I mean, the word pause, I have to do a word search, but the word pause is now very much there, and even the Fed speakers are talking about a level of caution. So I think a hawkish cut is already in this market.
Yeah, no question about it. And the good news is the expectation of the 0.3.
Yes.
Okay, and again, when we look at the story of 2024, it's also been the market's ability to digest a decreasing amount of ease. Remember, at the beginning of the year, we were pricing in 7 cuts, I believe it was, for 2024. But again, at nearly 25 times earnings, the market's a little bit more sensitive to anything less than perfect news than it might have been otherwise.
Well, I like how you've topped your note, which is exuberance rising. And in that, you basically say exuberance is rising at valuations of 25.4 times. That's among the highest in the last 60 years. Stocks are vulnerable to less than perfect news. And that vulnerability, I want some context around you. Exuberance rising, we know that you've got a pretty solid call up there at 6,600. Other people are up in the 7,000s. But you do warn there's going to be the risk of exuberant corrections. Quantify an exuberant correction for me.
If you look back, we think 2025, again, as you say, is a higher continuation of the bull market. But again, going this deep into the 3rd year at these valuations, emotionalism, which is something we frequently see, and we think within the context of a year that's likely to look like President Trump's 2nd year of the first term, 2018, you had events like Volmageddon, you had, which was a 9% correction in a matter of a couple of weeks. That's what these things are likely to look like. Is it going to be that deep at this point? This is more like a pause. And again, in December, you tend not to have those type of corrections. But as we get towards the end of the year, and certainly as we get towards Inauguration Day, where we are likely to see a flurry of activity, the market will be reassessing its view.
Yeah, and as we get those headlines, I think I did a little bit of research. As we got the trade headlines in the first administration, it was about a 1% correction on the day. If we look backwards, we had a near bear market at the end of 2018. So we dropped by 12%. The cumulative loss over 2018-19 was 12%, but we almost made a bear market at the end of 2018. We don't have the same relationship with China that we did then.
No, we don't. But when you think about 2018, and we think this is why investors took such heart in the appointment of Scott Bessent for the Treasury Secretary, is that 2018, you had two things. Number one, the Fed was hiking. That's not going to be an issue this time. Yes, they may cut fewer times than the market expects now, but they won't be hiking, in our view, under really any circumstance. That Powell will leave to the next Fed chair, I suspect. But also, the other aspect of that was because inflation was sticky in 2018, long bond yields rose. And the feedback loop in 2025 about what kind of policy can be implemented, how it's going to unfold, is going to be very much a function of how the long bond reacts. And the Trump government understands this much more in detail than they did in 2018.
Well, that's the Bessent bounce. I mean, when we saw that announcement, you had that Bessent bounce on the money on the Monday. The question is, has he really got the capacity to get a fiscal deficit down to 3%?
These things do not happen overnight.
No.
And the Department of Government Efficiency is certainly one of those things where it's going to be a work in progress. But the key here again is if you look at the last few weeks, the 10-year yield has settled into that range between 4 and 4.5. And our view is when you look at 2025, a lot of the time will be spent between 4 and 4.5, and that's a tailwind for equities.
So that's a comfort zone for you. I was just looking at some of the momentum data the other day. We had one of the worst days for momentum on Monday this week. Momentum has been a huge driver to these markets. How important is that going to be going into 2025?
Well, the stocks that have led the bull market, you don't really want to see them falter. And frankly, when you think about how bull markets end, they tend to end in one of two ways. Either a recession is oncoming, which we don't see, or you get that irrational exuberance. And as we said, there is rational exuberance now, enough sufficient to cause a pause in the rally. But the irrational exuberance tends to be led by the stocks that got you here in the first place. So we would expect at some point momentum to resume its dominance. However, when you think about the seasonality, December and January, the losers tend to do better in the beginning of the following year. So we wouldn't expect momentum to reassert itself straight away.
Okay, well, let's hope we don't get another Volmageddon moment next year. But you know what? I would imagine we will get a few hairy days and a little bit of volatility. Julian, always great to get your opinion. That is Julian Emmanuel of Evercore ISI. Coming up on the show, FTC, new chair, more on President-elect's pick for the seat on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Lena Khan seems to have missed the entire economic section in her college experience, because the role that she played in really reducing and eroding American productivity was profound. Was profound. So I think that for the United States, you know, all these issues around tariffs and this and that, you know, how much are we going to drill? It's all second order. First order, we're back to business.
That was the Citadel founder, Ken Griffin, speaking at the New York Times DealBook Summit earlier this month. And President-elect Donald Trump taps FTC Commissioner Andrew Ferguson to be the next chair. Trump wrote on Truth Social, Andrew has a proven record of standing up to big tech censorship, protecting freedom of speech in our great country. Andrew will be the most America First and pro-innovation FTC chair in our country's history. Joining me now, it is our government reporter, Kate Ackley. Kate, we know that Andrew Ferguson, I mean, he's an FTC commissioner. He's voted against, he's dissented against Lena Khan. You just heard Ken Griffin there, really quite visceral in regards to Lena Khan's tenure at the FTC. How different will Ferguson be?
Well, we're expecting that he will take a lighter touch than his current, you know, who will be his predecessor, Lena Khan. You know, he's been a critic of big tech and its censorship, what he calls censorship, particularly of conservative viewpoints. So he's not necessarily going to be a complete shift when it comes to big tech regulation or big tech, you know, keeping an eye on big tech. But overall, seems to signal a more sort of pro-business shift at the agency.
Yeah, well, but he's already on Twitter saying the FTC will end big tech's vendetta against competition and free speech. And I think, as you said, it may be a little bit more towards the side of Musk when we caught up earlier. Talk to me about the Biden administration. They are thinking about harsher sanctions against Russian oil. I mean, there was a great deal of prevarication over the price cap the first time around. Why, with just 40 days to go, is Biden prepared to roll the energy political dice that he was so loathed to do in the past 3 years?
Well, he doesn't have that much to lose right now. You know, you're not in the run-up to an election where, you know, you're concerned about the price of gas and inflation on voters as they, you know, would weigh that as they go into the voting booths. You don't have that. He's not setting the stage for his own picked successor. It's, you know, President-elect Donald Trump is coming in. And so I think that, you know, the reason that the Biden team is considering this is that they have, as you said, these waning days, 40-some days left to implement changes, to make policies. And so that's why they're taking a hard look at this without a lot to lose in terms of, and gas prices, if you've noticed, are pretty low right now.
They are. They're a heck of a lot lower than they were the first time around when we were looking at sanctions and the flow of oil onto the market. The president's also, we understand, ready to formally block Nippon Steel's proposed takeover of U.S. Steel. Now, we know Trump is also opposed to this deal in kind of principle. Why the final nail in the coffin now by Biden? What is the objective? Is it a political decision? Is it something that it's about his epitaph?
Well, this is something that's been a huge lobbying fight here in Washington over the past year plus. We've seen these companies both, hire up some of the top lobbying firms, try to sell their, case to the Biden administration, to people on Capitol Hill. It doesn't seem to be working. And in these, final days, it sounds like they're not going to get approval for this merger. The unions are opposed. So that gives you some insight. As you noted, there isn't going to be a big change from, the new administration coming in, with President-elect Trump saying he also opposes it. So, they're working through, the final details, but it doesn't look good for this potential merger.
Okay, Kate, thank you very much. Kate Ackley there of Bloomberg Government. Now, one stock that we're going to be tracking through the morning, it is Macy's, set to report their third quarter earnings just before the bell. Let's get to Dasha Afanasieva for the latest. Dasha, look, we had the top level results a couple of weeks ago. That was with a special accounting announcement, the $154 million in expenses that they were trying to get to the bottom of. So what do we get today? Do we get more clarity around revenue and this number?
That's right. They're going to drill down into the full results, and they're also going to have the conference call, which has been delayed 2 weeks, to give the company time to conduct an independent investigation into what happened. The reminder is that an individual apparently deliberately misreported delivery expenses amounting to as much as $154 million since 2021, and they're trying to get to the bottom of what's happened. And there's actually calls for a lawsuit. Law firms are sort of gathering people up to sue Macy's over this. So it's an extra problem for the retailer.
Well, they've got more than just that. They've got a new activist investor on the roster, Barrington. What are they calling for? I mean, it's not just, give us back a little bit more money, but it's a more sort of root and branch reconsideration of the shape of Macy's, isn't it?
Yes, well, together with Thor Equities, a real estate investor, they want a lot more money. They want an aggressive share buyback program because they reckon that that's the best use of Macy's money. On top of that, they want a separate subsidiary for the real estate arm. They want it to consider spinning off its higher-end chains like Bloomingdale's and Bluemercury. They also want seats on the board. They want them to close down their underperforming stores. And as I said, the share repurchases, of course, Macy's says it's going to work with investors, but it all, of course, speaks to this fundamental problem, which is that the real estate portfolio that Macy's has, which Thor estimates to be worth as much as $9 billion, isn't fully reflected in the market cap. And the reminder is that Macy's, of course, fended off a takeover attempt, which was sort of based on these ideas earlier on from Brigade and Ark House. And in February, it brought in a turnaround plan, which actually included selling off some of the real estate, which it's been trying to do. But shares are down nearly 15% since then, suggesting that the new CEO, Tony Spring, hasn't fully won over the market yet.
I mean, where is Macy's positioned itself? We've come to the end of this reporting season by retail. Some have had sort of landmines of inventory. Others really haven't had to discount inventory that much. So what's the state for Macy's?
Macy's slightly beat the sales numbers. The sales didn't decline as much as the market expected. And I think its inventories rose about 3.9%, which is also, which it sort of framed as an improvement. So it's not doing too badly, but with activists breathing down its neck, I suspect the performance has to be a lot better. And I think one of the things that these new activists want is lower capital expenditure, which means less spending on things like overhauling, merchandising, and appealing to shoppers, and investment into Macy's as a retailer rather than a real estate company, which appears to be what these activists are more interested in, really.
Yeah, but they want their capex to come down to what, to 1.5% to 2% of total sales from 4%. So that is a significant drop in the capex, is what the demand is. Dasha, thank you very much. Dasha Afanasieva, Counting Down to Macy's. Coming up, I'll set you up. It is CPI day. That's pretty much the only thing we need to focus on right here on Bloomberg Brief. Context matters.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
It's Bloomberg Brief. I'm Menace Cranny in New York. A look ahead to today, the main event. It is US CPI at 8:30 a.m. Then we have an exclusive interview with the Treasury Secretary, Janet Yellen. That is with Bloomberg's David Gura at 10:40 a.m. You have an auction, $39 billion worth of 10-year notes coming through. Some micro movers for you. This is what we've got. GM, they announced on Tuesday they're going to shut down the funding for robotaxi development of its cruise unit due to the high costs and the competitive market. Dave & Buster's earnings missed estimates, announced the resignation of the CEO, Chris Morris, and downgrades from Truist and William Blair. And you have GE Vernova extending its post-earnings decline. Revenue forecast for 2025 missed pretty much all the analysts' estimates. I'll leave you with a snapshot of the bond market. I can tell you this, Bank of America say you really are underpricing the potential reaction on the CPI. We're looking for a core CPI of plus 0.3% for the fourth month in a row. Inflation or disinflation is stalling.
what legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
It ultimately comes down to whether or not we see an unexpectedly higher CPI number.
If inflation suddenly starts to reverse, that could really cause it to pause at the December meeting.
If we get a stronger reading, then what you would see them do, I think, is still cut in December, but say, you know, we might be at that point where we would slow the pace of cuts.
We think that there is going to be a bit of upside surprise in these numbers.
Maybe we are either moving sideways or actually having a risk of inflation beginning to move higher.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. This is the day you have been waiting for. 2 hours and 30 minutes until the most important data point of the week. A key read on U.S. consumer inflation before next week's Fed meeting. Futures edging up after 2 straight days of losses, which is the first time we've seen that in almost a month. John Farrow is off this week. Danny Berger joining Anne-Marie and myself around the table as we look through what potentially could be the surprise right now, Danny. Not necessarily setting up for some sort of big CPI-related shock, but just a hint of concern with yields creeping up for 3 straight days, which is the longest streak in almost a month.
And I wonder what reverses that, what you need to get bonds rallying. Presumably, you need a big surprise to the downside, because 0.3%, what we're expecting, still shouldn't give the Fed any comfort. And Lisa, as I know you know very well, 4.5 hours after the CPI print, we're going to have to take in a long bond auction.
Well, and that's exactly correct. Thank you. You're speaking to the choir. We're going to be dealing with 10-year notes being sold at a time where there's a real existential question about how much inflationary pressure is in the works. And Anne-Marie, one of the key questions is the geopolitics of the moment. We've been talking about Syria, but there's a new kink on top of it. You were reporting overnight about potential measures that the Biden administration, yes, Biden is still president, might take to try to stave off some of those geopolitical threats.
Yeah, as they're looking into this potential glut that we see and a softness in the oil market right now, potentially what we could get is the Biden administration coming out and going after portions of Russian crude that they will sanction outright. So this is not an oil price cap. Think of the way the United States sanctions parts of Iranian crude, those exports. That could potentially be a risk premium you'd see on the oil market. We're still waiting, but the timeline is they have, what, 6 weeks to do this? The timeline is very short for them to get this done, but the market is saying potentially now is the only time, and it's after the election, that they'd be able to make such a sweeping move.
Which is the reason why, and I actually think it's fascinating and great reporting at a time where a lot of people are discounting the prospect of inflation and pricing in this sort of soft landing nirvana. How vulnerable the market is to a shock, whether it's coming from oil or whether it's coming from something else. And that, I think, is the reason why it's so important.
Well, Jim Reed over at Deutsche Bank in his note this morning says if inflation does make a comeback in 2025 and 2026, it may be centered around tax cuts and tariffs. So today's number is well before any of that might happen. There's so many unknowns that we can see in 2025.
Well, and this is a reason why I think it's notable that there have been 2 straight days of losses on U.S. equities. Danny, it really highlights the vulnerability at a time when so much euphoria has been priced in and you've brought forward a lot of the positivity without the negativity.
I was going to say all this fear might be simmering in the background, and then you get something like that small business optimism survey from yesterday, which sees the biggest jump since the thing started tracking in 1986. And it was remarkable to look at what CEOs said, basically saying that we're going to have scaled back regulations, high standard trade agreements, and avoiding overly broad tariffs. We're pricing in the good stuff and overlooking the bad stuff.
Well, coming up this hour, right now we're looking at a market that's trying to claw back some of the losses from the past couple of days. Coming up, Marvin Lowe of State Street with the S&P 500 on that 2-day losing streak. Justin Dare-Cole of ISO/MTS Capital Management ahead of key inflation data. And Sheila Kayaglu of Jefferies on our 2025 outlook for the airlines. People just keep traveling. We begin this hour with stocks taking a breather, but trying to inch higher ahead of one of the Fed's last data points before it meets next week. U.S. CPI at 8:30 Eastern. Marvin Lowe of State Street writing this: the Fed will continue to normalize rates, cutting next week, even as it likely further debates the neutral rate. The Fed outlook will remain below market expectations of terminal, even as it raises its long-term dot again. The market will just agree to disagree for the time being. Marvin joins us now. Right now, the market is disagreeing, sort of. At the same time, you are seeing this complacency around the idea that overall the U.S. is on a disinflationary trend. How vulnerable is this market to an upside surprise in inflation?
You know what? I don't expect an upside surprise to the degree that's going to kind of derail, if you will, the story that the Fed has to continue to normalize. They continue to think that we're restricted and there's room to get there. But we're getting there really, really fast. Whether or not we look at it from the market perspective, the market only thinks the Fed's going to get to about 3 3/4 next year. And then what? You know, it's a very different environment than when we were talking about interest rates that, you know, were neutral at 2.5, and a 10-year that could continue on in a 3% world. That doesn't exist anymore, and that vulnerability and whether or not we're really pricing it, you know, let's say after we get a lot more clarity on this administration, is certainly a risk. But, you know, right now the market is very happy with the fact that soft landing is still the story. Things are cooling in the right ways, and for the moment, you know, U.S. exceptionalism is a story that's really, really hard to push back on.
We're going to get to the whole question of what the Trump administration is actually going to do. But even before then, there's a lot of disagreement about where we are right now. And that's one thing that I am really struck by, where people disagree fundamentally on how much inflationary momentum there is in the underlying economy without the tariffs, without some of the potential tax cuts, et cetera. What do you make of that? Where do you stand on that debate?
Agreed. I mean, it definitely is looking at the best parts of the story. You know, on any trading desk, once CPI comes, you start cutting it up. And you listen to the Fed, and they used to cut it up in a way that they don't now. Supercore, which is kind of the services less housing, something that was so important, has been rising over the last couple of months. We don't hear them talk about it anymore. It used to be the number, if you will. There is enough disinflation on the good side of things to keep the story going, if you will. Shorter-term measures don't look as good. Spot threes per month, which is what we're talking about here, is nowhere near a 2% kind of target number. But overall, you do have those bigger components that are still going in the right direction. But again, whether or not we stop at 3 3/4, 4, is a big question that potentially is not as attractive to risk as, you know, this broader disinflation theme that the markets grabbed hold of.
Well, because the Fed's also grabbed hold of that theme too, to be fair. The recent speeches that we've heard from them is saying we're cutting not because we're worried about the labor market as they had said in the past, but because disinflation is taking hold. Does that mean, though, that if we don't know where neutral is going to be, we don't know whether we're restrictive enough, that they could end up cutting too much, especially as animal spirits are getting reawakened by what kind of policy we might see in 2025?
I mean, it's always a risk, right? You know, just really the interpretation of what tariffs are. Are they, you know, are they just temporary inflationary? And is there just a temporary inflation component to it, the way kind of the teal book that everyone talks about from 2018 says? Or is there a bigger downward growth aspect associated with that? All of that's in the mix right now. And we're going into this administration with a very different economic environment cycle than we had back in 2017, 2018. But the market is assuming, as it has throughout this entire pandemic cycle, that everything looks the exact same. And that has not proven to be true.
What do you think is the biggest disconnect in that regard, that we're assuming will be the same, that will not be the same?
Yeah, you know what? I think to be honest, the immigration component is the biggest unknown and really the biggest concern that I have. Just given where the labor market is, given the fact that foreign entrance into our labor market is critical, and we don't have economic models that really understand what the type of deportation policy this administration is talking about. It's incredibly stagflationary, and that is ultimately one of the worst kind of environments for a central bank and for an economy to deal with. On one instance, they should increase rates because you've got wage pressure as a result of that. On the other side, you've got the growth concerns, and yeah, that's all in the mix right now.
When it comes to this idea of sequencing of next year, what is your base case? And we might actually get some insight. Speaker Johnson yesterday was saying he's going to go to this Army-Navy game with President-elect Trump over the weekend, and that's going to be what they discuss on the sidelines.
I mean, I think 2025 is very complex from a fiscal perspective. I think the tax cuts, however they approach it, whether it's codification, whether it's a reconciliation, I think all the other promises, and I guess maybe we should all try to get our wages measured in tips. They're talking about all of that stuff, if you will. Plus the debt ceiling is a bigger, and tariffs as part of that, obviously, is a bigger pool of decisions that they've got to get through next year. For me, really understanding how they approach the whole fiscal side of things and whether or not we start to see tariffs as a means to an end or an end goal itself in terms of reordering trade will give you a sense, are they looking to cut deals? Because a lot of the comfort you get in tariffs is that it will look the way it did the first time. Deals were cut. So we don't import from here, but we could produce someplace else where a deal was cut. USMCA is going to be key to that. I don't think it was just random that Mexico and Canada were some of the first salvos.
But that's not up for renegotiation until 2026. So are tariffs...
My understanding is that parties can exit if they wanted to. So I would expect the administration to start saying that, we're going to start to relook this and rework this. And if they cut deals as part of kind of this 2026 deadline, or maybe even earlier, we'll get a sense this administration is looking to cut deals the way they hadn't in the past.
In order to keep gains in the stock market, do they potentially, if they're going to go with tariffs, negotiating or blanket, do they need to do that alongside the good stuff?
They do. They do. Yeah. Yeah. It's first 100 days, first 6 months. It's going to be action-packed in terms of a market that has, again, as you mentioned, Lisa, grabbed onto all the good stuff. It needs confirmation of the view that it has.
In the meantime, what we do see is one trade that continues, and that is the dollar being ascendant, and even more so today. And what we have is a twofold kind of turbocharging of it. On one hand, you've got a report out of Reuters talking about China maybe having a weak yuan policy at the same time that we've been reporting that the Bank of Japan doesn't see that big of a downside when it comes to holding off on a rate hike over at the Bank of Japan. So you put this and you start to wonder, how much do other countries use the strong dollar to either juice their imports, potentially help their economies, and how much, to the extent that it dampens inflation in the U.S., does it also dampen growth on some sort of level? How strong is too strong?
That's a big question. Ultimately, a stronger dollar with the role that the U.S. dollar has as a reserve currency causes a lot of problems. But what level that is ultimately anyone's guess. 110 on the DXY, from a DXY perspective, I think really starts to raise some eyebrows because it will get through levels that it hasn't been able to get through before. But yeah, it's hard to pick through a reason not to really like the dollar. It's the cleanest kind of either risk concern, tariff concern, administrative policy asset class that gets you where you want to get to.
Right now, you're looking at DXY at 106.74. Marvin Lowe of State Street, thank you so much. Really appreciate it. And Danny, to me, when I was looking at some of these stories about whether it's China or whether it's Bank of Japan, how much are people changing their view on what they think of a strong dollar as maybe we can use that?
And I also think it just underscores, this is something Torsten Slok has been writing about, that Trump's desire for a weaker dollar and some sort of Plaza Accord, it's not going to happen. These countries want weaker currencies versus the dollar. And even not mentioned within this is Europe. We're going to get an ECB decision tomorrow. Europe desperately needs a weaker euro in order to juice some type of economic growth.
Are we talking about a 50 basis point rate cut? That's one question being circulated, and every time I bring it up, people say, not a chance. Right now, let's get you a story, update on story elsewhere. Here is your Bloomberg Brief with Yahira Hackett. Yahira.
Hi, Lisa. The suspect in the murder of the United Health Group CEO is being held without bail in Pennsylvania after fighting extradition to New York. Authorities in New York have gathered evidence against Luigi Mangione, including surveillance video, autopsy results, and written admissions. They're seeking his return to New York to face second-degree murder and weapons charges. He's due back in court in Pennsylvania on December 23rd, unless he's extradited first. The Biden administration is weighing harsher sanctions against Russia's lucrative oil trade just weeks before Donald Trump returns to the White House. Our own Anne Marie and others here at Bloomberg are reporting Biden's team may target some Russian oil exports as fears ease over a spike in energy costs. The outgoing administration has also moved to ramp up military and financial support to Ukraine as it prepares to depart. And California authorities say the Franklin fire near Malibu has spread to at least 3,000 acres. The fire is forcing the evacuations of at least 20,000 people while shutting down a stretch of the Pacific Coast Highway. At least 1,500 firefighters are racing to fight the blaze, which is being fueled by dry conditions and Santa Ana winds. The fire is 0% contained as of late Tuesday with no fatalities. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira, and we do hope that it comes under control even more so in the next few hours. Up next, blocking the steel deal.
U.S. Steel has been an iconic American company for more than a century, and it should remain a totally American company.
I would not let U.S. Steel be sold to Japanese.
That conversation coming up next. This is Bloomberg Surveillance.
Politics to the world of business. Joe Matthew and Keely Lyons deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Two straight days of losses, and even though those losses don't add up to even a % decline, what you're looking at right now is a market that has not seen 2 consecutive down days. for almost a month right now, trying to claw back some of that. S&P futures up about 0.1%. Dollar ascendant with a whole host of regions from China to Japan seeming more amenable to the idea of a weaker currency, and yields just rising a touch ahead of CPI. Under surveillance this morning, blocking the steel deal.
U.S. Steel has been an iconic American company for more than a century, and it should remain a totally American company.
I would not let U.S. Steel be sold to Japanese, by the way. I would stop it if it hasn't been completed by the time I'm president.
Here's the latest. President Biden is planning to formally block the $14 billion sale of U.S. Steel to Nippon Steel. Sources telling us here at Bloomberg that Biden plans to cite national security concerns when the deal is referred back to him later this month. Bloomberg's Josh Wingrove joins us now. Josh, a question of just how much of a surprise this is, given the fact that what we just heard there was both Biden and Trump talking about how they plan to block this deal.
Yeah, in some ways, this is a story of consistency across both parties. Of course, back in September, there was a lot of coverage around this when the deadline was approaching, and then it was essentially punted. They did what's called a pull and a refile. It's a maneuver to buy time and push things past the election. Well, since then, a lot of people have been watching this wondering if Joe Biden was going to change his mind. Election's over, maybe the circumstances have changed. And meanwhile, Governor Shapiro, of course, a Democrat of Pennsylvania, is, at least according to Nippon Steel, kind of working behind the scenes to get the parties to the table to see if the union and Nippon Steel, the Japanese buyer, can come to some sort of agreement. It just doesn't seem like the union has gotten there yet, and our reporting is that the president's mind hasn't changed either. We're also reporting that another delay isn't expected. In other words, this can is not going to get kicked further down the road to President-elect Trump, as you heard him say, if it's not resolved when I'm in office. So we think that is not going to be the case. We are also being told that litigation is likely here. Whether that works or not, who knows? But this thing has been sort of bouncing along for almost a year now. It was late December last year when it was announced. And of course, this is an unusual CFIUS case to become a bit of a lightning rod. These reviews are normally aimed at China.
Well, also, Republican lawmakers last month are telling the Biden administration that they need to keep all the documents and the paperwork related to this case because they think CFIUS has been used for political interests, not national security concerns. Do they have a point?
Yeah, they think Biden has made up his mind here, or at least they're hinting to think that already, is sort of absent the process. That might be true. It seems also true that President-elect Trump has made up his mind here. So regardless of whose thumb is, there's going to be allegations, I think, of one thumb or another being on the scale. So, the CFIUS process here is secretive and includes ultimately a panel of advisors. These are many of them include, of course, members of Biden's cabinet. So the question is sort of what they will do in this process. The White House saying on the record for our story that President Biden believes it is, quote, vital that U.S. Steel remain both domestically owned and run. That sort of signals that any solution with, some sort of proxy board, they don't seem to be signaling an openness to that. They're also saying that the CFIUS process is ongoing. And what we can infer from that is that the file has not yet landed on the president's desk. The deadline for that, we're told, is December 22nd or 23rd, thereabouts. After that, he'd have a couple of weeks to announce whatever decision he makes.
Josh, we also heard from Trump yesterday vowing to speed up regulatory approvals for investors spending $1 billion or more in the United States. At the same time, he's saying, and has been on the record, that he would block the Nippon Steel, U.S. Steel deal. So how does the Trump campaign transition team square that?
We haven't. I don't know what to say. Yeah, when that landed, it was just like, oh, okay, I guess, except in certain cases for it. So he's pledging that. That's, regulatory rollbacks have been, in fairness, a bipartisan issue for some time. So cutting red tape to expedite approvals, things like infrastructure projects. Also, energy projects will be a big one for that. So in some ways, not surprising to hear Trump, call for that. But yeah, what is clear is that as is always the case with Trump, there are sort of, top line rules, and then everything is sort of a case by case basis. At least as of now, his stated position, most recently, including just last week, was that he will block this deal if it does indeed come to him. Now, the mechanics of that, I should say, again, our sources are saying that won't be the case. I don't understand how it could happen. The mechanics would have to be a little tricky. The companies would probably have to agree to pull and refile even if the CFIUS panel would. It's not clear to me and the people we're talking to whether an extension would even be feasible if there is appetite to it, and there's not much public interest of appetite.
Josh, just on the point of, if companies investing $1 billion, they get expedited permits, it kind of reminds us of a time when Trump makes these posts that are quite sweeping in nature without many details, and it's left to his cabinet, to his advisors, to put together the pieces of the actual legislation. Do we understand what something like this might actually look like in practice when, as you say, the DC for some time has been trying and failing to remove some of the red tape around these issues?
Yeah, we don't, and the reason you're enduring my sort of central casting hotel background situation here is that the reporters here in West Palm Beach who are covering the president, we're sort of sitting around waiting for like a puff of white smoke from Mar-a-Lago for him to put sort of meat on the bone of some of this stuff. And it's sort of trickling out. We had a couple of announcements last night of ambassadors, for instance, the cabinet is already, and then came this True Social post about the regulatory plan, if you would, theme. I don't know, what we would call it, but they have not specified yet where it would be. But, they have the trifecta right now, or they're going to. So all these things, I think, are signaling as Republicans in Congress really start to get down to brass tacks of how they're going to sequence things, what legislative tools they're going to use, what is the priority, what is not. So if anything, I think this is a signal to House Republicans, Senate Republicans of one thing that he wants to be wrapped up in any sort of big package that moves quickly.
Well, the other announcement we got yesterday was Trump's pick of Andrew Ferguson to lead the FTC. Josh, how different of an FTC would we be grappling with versus that of a con one?
I think it's safe to say different. It's one of the advantages of this appointment is he can be there on day one because he's already on the FTC. Lena Khan was a folk hero, is a folk hero for many of the Democratic Party, particularly progressive for her interventionist approaches. He's pledging to not follow the Khan model. It's interesting because Khan does have some sort of signals of support from certain parts of the populist, sort of, if you want to call it that wing of the Republican Party, including Senator J.D. Vance, who's sort of made more muted or less critical statements on her than other Republicans have. So I think there will be elements of the sort of antitrust populist agenda that overlap with both parties, but I think it's pretty clear right now that the Trump administration was not interested in continuing with Khan's approach, of course, because they could have just simply, explored keeping Khan. So now this is where we're going. But I would not expect Khan 2.0.
Josh Wingrove of Bloomberg, thank you so much, and good luck at the hotel in Mar-a-Lago. I'm glad that you brought up Andrew Ferguson, Danny, because right now we're looking at the potential for a rash of M&A. We've seen the announcements of a whole host of different mergers, whether it's Mondelez and Hershey's potentially. We've heard the rumors of that. We did just get Kroger and Albertsons being halted by a federal judge. You wonder how many of these companies are going to re-up some of these cases.
They very well might, but I think it's worth to remember that some of the ongoing cases, and Anne-Marie, you've talked about this, started in the Trump administration. Things like pursuing Google. So saying, okay, they might be reversed. We have this M&A euphoria coming. Goldman Sachs' CEO has been talking about it. I think there might be a moment next year where we kind of pause the brakes and say, it might not be as great and sunny as we all expect it to be.
That's the thread between Trump 1.0, Lena Khan, and now Andrew Ferguson. It's going to be big tech. And that was one of the things that Trump highlighted when this announcement came out. Andrew has a proven record of standing up to big tech censorship. When it comes to things like handbags, groceries, maybe this FTC is going to allow it to go through.
This is going to be something we'll track for a while. Coming up, we're going to have a conversation with Justin Dercole of ISO MTS Capital Management ahead of key U.S. inflation data. In the markets, you are seeing an effort to bounce back after 2 straight days of losses. This is Bloomberg Surveillance.
the Vivian Tom clientele.
Yeah, power women, like the dragon. Dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Hours until CPI, that key report before next week's Fed meeting. You've got futures trying to tick upward after 2 straight days of losses, led really by the NASDAQ, which has been outperforming really in the past couple of weeks, up about 0.25%, up about 1/10 on the S&P. Yields continuing their climb. This, to me, really stands out. There have been 3 straight days of at-the-close yields being higher, 2s, 10s, and 30s, Danny, at a time when people are wondering how much they might be underpricing the risk of inflation being a bit stickier.
This is the thing. We could get everything as expected, 0.3%. We say, great, it's as expected. The Fed's going to be cutting. That's what markets are pricing. And then I think we need to have a really serious conversation about inflation next year. As Anne-Marie pointed out, this number comes even before we understand what the Trump administration is going to do. This number comes as we're dealing with more bond auctions. Just today, even if it's in the all clear, there's some serious questions that need to be answered.
Especially at a time where there still is a massive geopolitical overhang. And Anne-Marie, I keep going back to this. There's a question of how much oil prices and gasoline prices could increase if some of the sanctions really go through with respect to what Biden is talking about on Russia currently.
Well, again, they're under discussion right now within the administration is a lot harsher sanctions than we've seen. And this really wouldn't be up for discussion ahead of the election or if prices in gasoline were higher right now. But they see this as a moment that it could be appetizing before they leave the White House to give Ukraine this final push. And this would be outright sanctioning portions of crude the same way the U.S. has sanctions on, say, Iran. On top of that, potentially also going after more of Russia's shadow fleet. This is something the UK and the European Union have also been doing.
We've got more on that in just a minute. Meanwhile, you do have a dollar that is ascendant at a time when you've got China and you have Japan making noise that maybe they are not as concerned about a strong dollar. Japanese yen falling yet again, 152 the dollar versus the yen, as the Bank of Japan seems to be amenable to the idea of waiting, that it isn't going to be that costly. And there are reports that China is going to maybe pursue a weak dollar policy. Under surveillance this morning, something that has the attention of every parent, every executive out there, Luigi Mangione, the man accused of killing health insurance executive Brian Thompson, is being held without bail in Pennsylvania. Mangione is fighting extradition to New York, where he faces second-degree murder and weapons charges. The move could delay his return for weeks, and in the meantime, everybody is glued to this story at a time of pretty significant implication, Danny.
It does. There was a CNN and Times story basically saying that the New York PD had a document saying that police are concerned that they're going to see this man as a martyr, an example to follow, and likely view him as a hero of sorts. I think the discourse around this has been extremely concerning because you see some of that bubbling up online. Nothing is justifiable for this type of violence. I think that's abundantly clear. But you have people online almost celebrating this. It's really concerning, and it's led to CVS, for example, has actually taken down the images of their CEOs on their websites. Corporate America is very fearful at this moment.
And corporate America, and we spoke about this, is starting to look at the security around their top executives. What's so interesting about this case is that this investor conference day, there was a lot of security inside the building, no one was with that CEO as he was walking in.
Which is a reason why people are wondering what happened on multiple levels. Meanwhile, the Biden administration is weighing new sanctions on Russia oil, as we did hear Anne-Marie talking about before Trump returns to the White House. Sources telling Bloomberg details of the possible new measures are still being worked out, but the team is considering restrictions that might target some Russian oil exports. Anne-Marie, wonderful reporting. On a broader level, there is a question of what the Biden administration is trying to do ahead of its exit from the White House, and it goes with respect to potential sanctions, but it also goes beyond that.
So I think there's two things. It's the timeline. It's finally after the election where they can maybe go for some of these harsher measures that they would not think of before an election, and it's before an incoming Trump administration. So it would also put Trump in a rock and a hard place. Would he then come in and offer waivers to Russia? Probably not. And if oil prices are higher, that is also going to be concerning for him as he ran on the president that can tame inflation. What is so interesting about this is that we have seen incrementally the administration want to be harsher on Russia. They rolled out last month these sanctions on Gazprom Bank. This would be, though, for the first time ever, going after directly the crude that leaves Russia's shores. Not a price cap. They're not going to be able to basically trade it, but within a cap and a price that the U.S. and the West deem doable. This would be going after actual crude. So potentially this could be higher oil prices following an announcement if they come to that decision.
Watch this space. In the meantime, General Motors is getting out of the robotaxi business. The company is saying it will combine its two units, both of what we're seeing with respect to the Waymo and the Cruise, as well as potentially some of the technological teams associated with it, into a single effort focused on developing autonomous and advanced driver safety and technology. Danny, I'm trying to understand what the motivation could be here for this, especially at a time where we're seeing Tesla fly high.
I say on one side, you could say, okay, not surprising. They're already scaling back their EV. They're restructuring their business in China. They're going on a cost-cutting and saving operation. But on the other hand, I think you're completely right. The timing of this is odd, to the point where even TechCrunch was reporting today that employees were blindsided. They learned about this when everybody else did with the press release. You have a time where a lot of companies are racing to join this exclusive robo-taxi club. And let us not forget what this does to valuations. We've talked to how many people? I'd say the reason that Tesla should be bid up is because the future that this promises. This is GM missing out on a big chunk of that.
And to be clear, this is the Cruise self-driving car unit and its technical teams. Is there some sort of strategic advantage because Musk right now, Anne-Marie, has the ear of the president?
I mean, I think proximity to power is probably helpful, but if that means that potentially this can roll back regulation, then anyone that's in that space would likely be lifted up, not just Tesla and Elon Musk. What I think is interesting, what if actually the robo-taxi business does become profitable? Will they look back and say, maybe we should have stayed in that? Another interesting factoid, GM pulled the plug on their revolutionary attempt at a commercially viable electric vehicle in 2003. That was the same year Tesla was founded. So while, yes, maybe the cash flow helps right now, I wonder if hindsight is going to say, maybe we should have stuck with it.
In the meantime, it is less than 2 hours to the latest read on consumer inflation. The key question in markets is whether traders are overestimating or underestimating the inflation forces in an economy still distorted by pandemic effects. Justin Dercole of ISO MTS Capital Management joins us now. Justin, you have a contrarian view at a time where everyone is welcoming the disinflation that seems to be incoming. You think that there is a stickiness and a pervasiveness to this inflation that most people are not recognizing. Please explain.
Yeah, so I continue to believe that the right way to think about this is to look through the lens of what you've been hearing over the past several months. In this case, I would say the risk management cuts. Remember, that was the term that people were using as it relates to what the Fed should be doing in August of this year in anticipation of this unemployment rate increase that manifested itself because of largely due to immigration. My view is that the market right now, pundits, the sell side, et cetera, are to a degree fighting the last war. And I think Mike McKee has made mention of this. And what I mean by that is there is an unconscious bias going on as it relates to what is going to happen to inflation. born out of 10 years post-global financial crisis of low rates, low growth, and no inflation. And so what continues to happen is the natural behavioral response is impairing the ability to see what's actually happening. And what I believe is actually happening is that the disinflation, a big chunk of what we got was down to China's economy rolling over much harder than anyone anticipated, and a normalization of supply chains. Now that those two things are largely behind us, the other thing that really was what was born out of that was goods prices coming down. And what you'll see today in the CPI is goods prices are now inching back up. And when you talk offline to street sell-side economists, I think they're wary of the fact that when they look at the basket, when some things are getting better, it is entirely likely some things are getting worse. And let me just...
Well, hold on a second, Justin, before you keep
please.
going. There is this question on a broader level of just how offsides markets are. And this is about short-term and this is about long-term.
Yes.
Where do you see the markets most offsides?
So the biggest risk is this free float of Treasury coupon notes and bonds, so the longer dated part of the market. The reason that is the risk is look at the shape of the curve. Everybody's been waiting for a steepener, and I think that's entirely correct. But the risk is if you look at the amount of Treasury securities that are effectively available to be traded now as a percentage of GDP relative to 3 years ago, before the Fed started QT, and before the massive deficit spending that has inflated the deficit and the debt, you now have this extreme risk. And that risk is exceptional volatility across really all asset classes. If the Treasury market is sort of the core basis upon which our financial markets are built, which it is, and then you say to yourself, okay, the uncertainty associated with rates and where nominal rates are, those two inputs feed vol. And the market is, now it's not universal anymore as it was this summer, by the way, which was mistaken, but I continue to sense this belief that we're going to go back to living in the post-global financial crisis environment.
Justin, what happens, though, at a time where that's occurring, yet around the world there is discontent? In Europe, in Asia, governments facing issues, and it's led to this narrative that the reason we're still buying U.S. bonds is because there is nothing else.
Right. So Germany actually tried to avoid the sidestep the debt brake, and that's why they're going to have an election in the second quarter. Germany, I think, believes they're the growth engine of Europe. The fact that they're underperforming on a GDP basis, Spain and Italy suggests to me that they're going to do everything they possibly can to get that thrown back. And so I think like the amount of spending is actually at risk of accelerating. And the answer to your question ultimately is like the nearshoring deglobalization item. Think about what China said about NVIDIA yesterday, what their focus is. Like this is building, it's building, and the pieces keep coming together. I focus on banks as perhaps you remember, and the key point is the difference between the post-global financial crisis period and now, among other things, but one of the biggest is if the banks are the engine to the economy, they're the portal through which Fed policy flows. They had terrible capitalization after the financial crisis, as you know, and they were terribly unprofitable. And the opposite is the case now. So the other thing you can say is that the economy actually has a significant incremental support system.
Justin, I'm also curious because the other thing we have to contend with is just what happens next year, this big unknown. But even before that, we have vibes and animal spirits, small business optimism survey jumping the most since 1986. You look at CEO surveys, plans for hiring, plans for CapEx, plans for expected sales. All of them are up. At what point do vibes turn into an inflationary force?
Right. And so this goes back to the Fed making the decisions they made late summer, early fall around these risk management cuts, I think was mistaken. I just do. I think that the answer to your question is that we now have 2 years of data that supports that the neutral rate is higher. And so you only know the neutral rate ex post, meaning after the fact. You look back and you say, what did inflation do and what did growth do relative to a policy rate, all else equal? And we're growing at over 3% using Atlanta Fed in the fourth quarter of this year. We grew at 3% in the third quarter. The policy rate's been above 4% for 2 years. So it's not debatable anymore. This is the nuance. This is and I am so sympathetic to people like Torsten Slok, who comes onto your program, does a great job, and this summer seemed like he was a total outlier. When is the future the present? That's what people need to ask themselves. That at what point do we accept GDP for what it is, as opposed to saying, okay, but it's going to roll over for these reasons? It doesn't make sense to me. I think the risk is getting higher and higher and higher. Credit spreads are at their tightest level since 1997.
Yeah,
we know what happened in 98.
Yeah, Justin, unfortunately, I've got to leave it there. Thank you so much. Justin Derek Cole of ISO MTS Capital Management with a passionate explanation of why he sees this as currently the new normal and, frankly, an acceleration in inflation ahead. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. U.S. President-elect Donald Trump has picked Andrew Ferguson to chair the Federal Trade Commission. Trump says Ferguson has a proven record of standing up to big tech censorship and supporting freedom of speech. Ferguson, who is already one of the FTC's 5 commissioners, will replace Lena Khan, who during her tenure drew ire from Wall Street and Silicon Valley. Meanwhile, Eli Lilly is planning to start studies to see if its blockbuster weight loss drugs are also effective at controlling addictive behaviors. Eli Lilly CEO David Rick sat down with David Rubenstein yesterday at the Economic Club in Washington.
Next year, you'll see Lilly start large studies in alcohol abuse, in nicotine use, even in drug abuse. We'll also begin studies in anti-inflammatory conditions, because you don't think of that with weight, but actually there is quite a strong signal in anti-inflammatory.
Ricks also addressed the imbalance in drug prices between the U.S. and other countries. He said patients abroad should be paying more for their medicines. And Apple's next smartwatch will be able to send texts via satellite. That means users will be able to send messages even when they're off the grid. According to sources, this is part of a number of upgrades to the smartwatch, including a long-awaited feature allowing users to check their blood pressure. Apple hopes this will entice hikers and health-conscious consumers to upgrade their devices. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira, so we can manage our step count anywhere we go, even the forest of Death Valley.
The whole point, I think, of going off the grid is so you can't be in touch with people and you can get away and calm down. So,
well, clearly I haven't been to Death Valley if I'm talking about a forest there. Meanwhile, up next, supply chains weighing on travel.
What's really impacting on the industry is the supply chain problem. So although next year will be better financially, I think it would have been a lot better had we not faced all of these supply chain problems that have been going on now for some time.
That's coming up next. This is Bloomberg Surveillance.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Markets with an optimistic tone this morning ahead of CPI, about 90 minutes away from that print. Under surveillance this morning, supply chains weighing on travel.
What's really impacting on the industry is the supply chain problems. So we're looking at 8% growth next year, but costs are being heavily impacted by the delays in getting new aircraft, keeping older aircraft in service. So it's quite a lot of moving parts. So although next year will be better financially, I think it would have been a lot better had we not faced all of these supply chain problems that have been going on now for some time.
Here's the latest. IATA expecting a record number of people to travel next year despite supply chain issues, putting pressure on the sector. Sheila Kayaglu of Jefferies writing, passenger revenues are expected to expand in 2025. Supply chain continues to inhibit industry as deliveries fall short. Sheila joins us with more. And Sheila, is this basically shorthand for those tickets are going to cost you?
They will, and we're finally starting to see that. Not in mainline U.S. Domestically, ticket prices are still normal, but when you're going, across the Atlantic, I think you're seeing pricing really tight there. So it's actually driving some profitability improvement, and IATA's forecast is back to peak levels in terms of profitability margins that they're expecting.
Can you expand on that? Basically, how much of a premium can you imagine on flights based on restricted capacity over to Europe because a lot of these airlines have been unable to receive their Boeing airplanes?
That's the pitch from the airlines, and that's really why you're seeing such outperformance in the airline sector since September. For domestic ticket prices, we're seeing pretty neutral pricing in the second half, but internationally, we're seeing ticket prices up pretty significantly. They don't quantify those numbers, but margins for the network carriers are 20%, especially on the international side. So that's really helping drive double-digit profit margins for airlines, which we haven't seen in a while.
When it comes to supply chains, we might get some answers very early next year, whether it be Trump saying on day one he wants to start some of these tariff proposals, whether it be the strikes coming from the port workers that would also put some stress on air cargo. What sort of rates are we talking about? Is the peak going to be higher this time around?
Certainly not. So in terms of Boeing deliveries, Boeing and Airbus combined, we're forecasting about 1,250 deliveries for 2024. At the start of the year, that number was closer to 1,600. So our forecasting is terribly wrong, or the supply chain had an issue somewhere in there. I think it was the supply chain, the Boeing strike compiled on top of that. So if you think about IATA's global forecast for growth next year, it's 8% air travel. We estimate you need about 1,500 to 2,000 new airplanes a year to provide replacement and new growth demand. So we're at 1,250 this year. So we're going to continue to see the supply chain slowly ramp. We saw that a little bit yesterday with Boeing's deliveries, obviously 0 in October. In terms of production rates, 9 deliveries in November for the MAX. Those numbers should be in the 30s. So we're going to slowly see that rate of change, or quickly see that rate of change improve, and that's why investors have started to look at Boeing's equity.
With how these individual airlines deal with this, I was really struck by a Wall Street Journal story about JetBlue. Their turnaround plan basically cut costs by removing some of the various routes you have, but focus on the high end. Give people ultra luxurious lounges, expand first class. Do you think we'll be in an environment in 2025 where that is still the model, where that can still help someone like a JetBlue turn around?
It seems the premium offering is really where airlines are outperforming. So carriers like JetBlue are looking at Delta and United and seeing their profitability margins, which is mainly international travel, but trying to replicate that, whether that's JetBlue or Southwest in the US, adding more premium seats, adding extra legroom, and that extra legroom could be defined as 3 inches, which I don't know what kind of premium that warrants in terms of a ticket price. So, I think it's up to one to decide what they're willing to pay for the ticket. For me, on-time travel is the most important.
When you mentioned JetBlue, so I have to go here, the JetBlue-Spirit merger that we saw collapse under the Biden administration, could we expect more consolidation in the airline world 2025, 2026 because of Trump?
That's what airline management teams are likely hoping for, but I also think, do we necessarily need that capacity? When you look at U.S. domestic capacity, we had 6 to 7% increases in the first half in terms of the number of planes taking off, and ticket prices were down mid-single digits. So there was somehow excess capacity. That's because everyone was going to the same area. You had travel going to Florida, or you had excess capacity and flights folks no longer wanted. So that's now being taken out of the system, and it's probably for the best, whether it's deregulation or not.
Sheila Kahyaoglu of Jefferies, thank you so much. And I have to say, if we're paying by inch, I think that I'm going to get really sad if we start saying, if you've got 2 extra inches, you got to pay what? 25, 50?
But they don't tell you, and now I'm kind of worried because I am someone, even though I have extremely short legs, I have paid up for extra leg room, and now I'm like, maybe I was only getting 3 inches, and it was all in my head that it was somehow more roomy.
Every inch counts.
Well, honestly, I just wonder, what's next? Premium access to the toilet? Are you going to end up paying for the oxygen? That's sort of my game changer. You start paying for the oxygen, that's game over. But let's move on. Coming up next, we've got Stuart Kaiser of Citigroup, Monica Guerra of Morgan Stanley, Republican Congressman French Hill, who's up to head the Financial Services Committee, and Dana Telsey of Telsey Advisory Group, as we await numbers from Macy's. Remember that was pushed back after an issue with some sort of malfeasance around shipping costs. Right now, you're seeing markets just turning ahead of that CPI print. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The long-term potential and a lot of the excitement around AI is hard to deny.
Everybody's, getting bullish on the growth outlook, at least in the U.S.
We do want to embrace equities at this stage. The problem is that a lot is in the price.
Expectations are just very high in too many places.
12 months from now, we are in a higher place, but it may not be an easy ride to get there.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. 90 minutes until the key data point of the week, the last major inflation read ahead of next week's Fed meeting. John Farrow off this week. Danny Berger joining Anne-Marie and myself around the table. We're looking at futures on a broader level, which have been trying to bounce. But what you do see is a real question around just how resilient and how strong the consumer is at a time where there has been incredible divergence between the winners and the losers in the retail space. As we drumbeat toward the CPI print, Macy's comes out with their delayed earnings following a suspension earlier in the month. And the real question here is what went wrong? Macy's revising downward its full year earnings forecast, talking about the full year adjusted earnings per share of $2.25 to $2.50 versus a high of $2.90. Danny, on a larger scale, how much can they just blame a lone employee, and how much does this speak to the difficulty for the losers in the retail space at a tenuous time?
Well, let's be clear. They are blaming that employee in this earnings report. They're saying, look, this is why we have to revise things. Shares down decidedly, though, with this idea that Macy's has other issues that it's struggling with. And maybe this is just an example of it, of credibility, of strategy that's lacking at the company. Macy's has an activist investor, multiple involved in it right now, wanting various things to happen, wanting them to spin off their luxury offerings, wanting them to spin out a real estate unit. But how much of all of this is just financial engineering versus a real strategy shift that needs to happen at Macy's?
In the meantime, this is something that we have seen consistently, which is the winners of any earnings season, particularly in the retail space, get celebrated, shares pop upward. When you have a disappointment, they are penalized, and penalized significantly. You can see that with Macy's right now, down more than 8%. A real question here about how vulnerable consumers are to further bouts of inflation. In other words, how much they're pushing back against some of the price increases that we saw a couple years ago, which is the reason why people have conviction that maybe this disinflationary trend could continue.
Right, and we've seen this theme in the retail space, this idea of you see a lot of consumers being more choiceful, but they're still going out and they are still spending. What I find interesting is look at the latest survey data, and it's almost flipped. And we heard John Authors talk about this when it comes to inflation, how political it is. All of a sudden, Republicans start to think the economy, inflation, we're in a good place. And it's Democrats that are saying, actually, we're not. So you really need to look at, I think, all of the data to really decipher what kind of consumer we're dealing with.
That's the reason why CPI is really important at a time where there's big disagreements between whether we are heating back up or on the precipice of something more significant. Danny, at this point, it feels like this is a market leveraged to good news, which is the reason why we have seen a couple days of stalling out as people worry maybe this stickiness is going to be present.
Right, because two things can be true at once. You can get inflation numbers coming in that confirm that the Fed will be cutting in December and still be worried that the path down to 2% is going to be a complicated one. 0.3%, what's expected, and if we get that, everybody is going to cheer and say, great, the Fed's going to cut. That's not exactly comforting figures. That's also not comforting figures ahead of an unknowingness and a fog around 2025.
Exactly. It's not a question necessarily of next week, but maybe in the year beyond. Coming up this hour, we've got Stuart Kaiser of Citi. As markets await that CPI report, Monica Guerra of Morgan Stanley as Biden defends his record on the economy, and Congressman French Hill on President-elect Trump's plan to boost industry. We begin this hour with stocks higher as markets await CPI, key data point ahead of next week's Fed decision. Stuart Kaiser of Citigroup weighing in. If inflation matters, then it's probably bad news. CPI has been priced as a smaller event than payrolls and FOMC. That reflects the downward trend in inflation and recent FOMC confidence that process will continue. That backdrop means a downward surprise will be far less impactful than surprisingly strong inflation, which is something that we can see right now in markets and how they've been responding. Stuart joins us now. Thank you so much for being with us. How offsides do you think this market is, and not necessarily pricing a significant move?
I mean, they're only off sides if the data comes in hot, I guess, right? maybe they end up wrong sides. Look, I think, at the last FOMC even, Chair Powell was really trying to hammer home the fact that they think inflation is on a downward path, and that's going to allow them to kind of ease policy from a very restrictive point. Our economists are 25 basis points or a little bit below on core CPI. I think if you get a print like that, to Danny's point, equities are going to take that positively and kind of rally. To the upside, you would need a massive upside surprise in inflation, not only in the level, but I think in the constitution of that print to really disrupt markets. And frankly, at this point, you might need multiple of those in a row to change the Fed stance at this point.
This is an important point, given the fact that some people are looking at a couple of hiccups in the past couple of days as evidence that people are increasingly concerned about inflation. You have the likes of Justin Dercole coming on and pounding the table saying, this is a market that is fundamentally underpricing inflation. Are you saying that really this is a pretty clear-headed market that is looking at all the incoming components, and isn't that susceptible to an upside surprise unless it really kind of knocks your socks off?
I mean, you are susceptible here. I mean, the consensus is that we are on a downward inflation trend. The Fed believes we're in a downward inflation trend, and you're going to need, I think, something to kind of significant to disrupt that. The Fed does not seem worried about inflation being a little sticky above target, for instance. So, if that's your view of what the market's underpricing, I don't think the Fed's going to care about that. I don't think the markets are really going to care about that. Look, if you got a tariff impact, if you got things like that really created an inflation impulse, I think that's a separate discussion. But I think it's going to take a whole lot to take the Fed off their core view right now.
How do you gauge sentiment at this moment? Because some of the metrics like cyclicals outperforming defensive, insane flows into U.S. equity funds, but at the same time, cash holdings continue to go to an all-time record. Is this a euphoric market or something different?
I mean, I think sentiment's pretty good. I think ETFs, which you mentioned, is probably the thing that's really shifted over the course of the last couple of months post-election. Retail is really getting, I think, aggressively involved in U.S. markets. And look, that's an investor base that's probably a little less sensitive to the percentile rank of valuation or, the amount of EPS that's priced into next year. So, yeah, I think sentiment's very positive, but I think sentiment's positive for a reason. The economic growth's been surprising to the upside. There is a view that the deregulatory and tax impulses from the Trump administration are going to be positive, and people are kind of following through on that. So yeah, I think sentiment is actually pretty positive. If I had to summarize it, people are long U.S. versus rest of the world in the equity space, and it's going to take something to kind of shift that trend.
I was going to say, I mean, we should be clear. It's good sentiment around the U.S. That ETF figure, it's been outflows for the rest of the world, for Europe, for emerging markets, for Asia. What does shift that? Is there anything, or is this going to continue to be a U.S. exceptional market and Europe and emerging markets, we're going to struggle to buy.
Yeah, look, I think the concern we've heard about EM and Europe is more that they are consensus underweights and consensus shorts. So you do have sort of a positioning dynamic that could kind of disrupt that. But again, you need a catalyst to do that. So what is that catalyst going to be? Look, you have a lot of elections coming up in Europe that could impact it. You could get large China stimulus, and that could really support things. The question is, from an equity investor's perspective, is there going to be follow through on that? You know, if you look back to China 6 weeks ago, they kind of surprised the market. Then they went into Golden Week. The market was very excited. You came out of Golden Week, and they just didn't follow through enough. So I think both for Europe and China, you could have episodic periods of outperformance, especially given the positioning dynamic. The question is follow through. And if you don't have that follow through, then the U.S. is going to be back in the driver's seat.
Does it concern you that it feels like everyone is pretty much lining up, and this is all consensus right now?
It does. I mean, from a positioning perspective, it does. Like if you rewind 12 months, this was the case in small cap, right? You had everybody was really deeply underweight in short small cap. The Fed guided to rate cuts, and boom, you had this massive sort of positioning driven rally in small cap. Same thing happened in July, to be completely honest with you, when you got that friendly inflation print. So the positioning and sentiment setup is a little bit offsides, to Lisa's point, on U.S. being sort of exceptional versus rest of the world. The problem is when that comes up, the next question is, okay, well, then what do I own instead? And that question is very hard to answer now. It's hard to convince someone to sell the U.S. and buy European equities right now, or sell U.S. and buy EM. So yeah, risk reward wise, it does kind of concern us fundamentally. It kind of makes sense.
What if Trump gets his entire wish list and we see a ton of fiscal spending and bond yields go up? Then what do you do?
Bond yields to us is the #1 market risk to equities. So that longer end bond yield, and I mean like 30-year type bond yields. To me, that is the #1 market risk. The #1 data risk is on the labor side of things. So those are the two things we're trying to manage. You know, our view is be long equities, but hedge sort of bond term premium, kind of dislocated to the upside. So yeah, I agree with you, massive risk, and I think that's the key kind of market risk out there in the system right now.
What about cash flows? Because a lot of the optimism has been cash flows are higher, they're going higher. What happens if all of a sudden we have companies that are going to face pressure to be investing in the U.S. and domestic industry?
You know, I guess, we'll have to see, like, what does the CapEx outlook look like? What does the buyback outlook look like, relative to that? Generally speaking, large cap U.S. corporates, the safest balance sheet in the world right now. So they have the capacity to spend. They have the capacity to do that. I think the question is, are they getting forced to do a spending sort of program that is inefficient and sort of destructive to ROE and margins? If that's the case, then yeah, you have a risk because that EPS number is sort of high in the out year. But look, if they're just being encouraged to invest and incentivized to invest in the U.S., then that's not necessarily a bad thing, I don't think, for the market.
Well, to build on that, how much is signal and how much is noise in some of the recent rotations away from maybe some of these small caps into large caps, into big tech, away from some small caps? I mean, you talk about how some of the positioning shift really indicated euphoria to you before. Why are tech stocks outperforming small caps by so much over the past few weeks?
Yeah, it's a good question. I mean, last week in particular is one of the bigger weeks of sort of large cap tech and growth outperformance that we've seen in a long while. It's kind of reversed a little bit this week. I think some of that is basically just the ebb and flow of markets and positioning. And some of that is, if you have ETF buyers and foreign buyers, I think that demand source tends to focus on larger cap U.S. equities, to be completely honest with you. Foreign investors, I think, want to own large cap U.S. tech because that's something you can only find here. ETFs tend to go into Qs and SPYs and things like that. So I think some of it is just a normal ebb and flow, and some of it is the type of buyer that we're seeing generally gravitates towards that type of stock.
2024 has been an amazing year when it comes to stock returns. Why does it feel so exhausting and so ready to end?
I mean, it's a good question. I would like to blame it on politics, but Emery's here, so I'm not going to.
What about the market? Coming into the year, into the year, 6 or 7, 8 Fed rate cuts.
Oh yeah,
we've had 2.
Oh yeah, blame it on that.
Look, I think look, you definitely have had some data surprises that have gotten us. You've definitely had a little bit of politics that have gotten us as well, and even the weather's been bad. I mean, it's just been a tough year all around.
Stuart Kaiser of Citi, thank you so much. Hopefully, 2025 will be a brighter year, if not for stock returns, then at least for the weather. Let's get to an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackett. Yahaira.
Hi, Lisa. Macy's shares are falling in the pre-market. The company reported third quarter earnings that missed slightly on revenue and net sales, and a miss on the outlook as well. Macy's seeing its full year adjusted earnings per share coming in at a lower range than expected. The results coming after a weeks-long delay after an investigation late last month revealed an employee hid more than $100 million of expenses over several years. Shares are down 8%. Meanwhile, shares of U.S. Steel are up slightly in the pre-market, about 0.3%, but that's after plunging yesterday when we reported that President Joe Biden plans to formally block the $14.1 billion sale of the company to Japan's Nippon Steel. According to sources, he plans to do this later this month, citing national security concerns. U.S. Steel said the deal is a lifeline and warned it may shutter some operations if the merger collapses. And Kroger's $25 billion acquisition of Albertsons has been blocked by a federal judge. The judge saying the takeover would lessen competition for U.S. grocery shoppers, siding with the U.S. Federal Trade Commission. The two grocers are now reviewing next steps, with Kroger considering an appeal. The company spent nearly 2 years attempting to merge, with Albertsons aiming to become a bigger player and compete against larger non-unionized rivals like Walmart. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the weather. No, just kidding. Biden taking aim at Trump's tariff plan.
He seems determined to impose steep universal tariffs on all imported goods brought to this country. Who do you think pays for this? I believe this approach is a major mistake.
That's coming up next. This is Bloomberg Surveillance.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
75 minutes until that key CPI print. Will it be an upside surprise? That's basically what a lot of people are trying to figure out. This from Bank of America, derivative strategist saying the market is underpricing CPI risk. We believe CPI matters more this time. Don't tell it to S&P traders, because basically futures up 0.1%. You can see a bigger outperformance on the Russell 2000. Across the board, yields ticking just a third for a fourth straight day if it closes this way. 424.77 on the 10-year, and dollar strength pretty much across the board on the heels of a couple of key signals coming out of China and Japan. Under surveillance this morning, Biden takes aim at Trump's tariff plan.
He seems determined to impose steep universal tariffs on all imported goods brought to this country, on the mistaken belief that foreign countries will bear the cost of those tariffs rather than the American consumer. Who do you think pays for this? I believe this approach is a major mistake.
Here's the latest. President Biden saying President-elect Donald Trump's plan for broad tariff hikes will hurt American consumers. Biden taking an economic victory lap even after his policies were widely seen as contributing to the Democrats' election loss. Joining us now is Monica Guerra of Morgan Stanley. Monica, thank you so much for being here. Happy holidays. I think we're doing that now. I wanted to start with what you make of President Biden trying to put certain things into place, rushing to do so ahead of President-elect Donald Trump taking office.
Yeah, this is all about legacy setting. I think that that's pretty clear. He's trying to get as much done in the next, 3 weeks, 4 weeks as possible. What we're likely to really see is a move towards trying to keep jobs in the U.S. That's essentially what Biden's trying to do. He's trying to say that I have a strong economic legacy as well, despite what the electorate might think. And although he might be stopping this deal around U.S. steel, what we're likely to see is, a pro-deregulation agenda under Trump that might essentially flip that on its side. So Biden can try to get as much through as possible without really strong legal structures in place. That could make that legacy still easily unwound by the next administration.
Before we get into Trump, Biden and I reported overnight that they're looking on fresh sanctions, a lot harsher sanctions on Russia, basically waiting to the last minute till they leave to, one, this put Trump in a rock and a hard place, but also give a little bit more support to Ukraine. Do you think we're going to see a lot more of those kind of actions on the foreign policy front before they leave office?
So we don't have a view on sanctions. I want to make that clear. But what you're likely to see is, again, Biden sort of reaffirming our commitment to Ukraine, trying to reaffirm channels with NATO, essentially reminding everyone, right, how different policy-wise what the Biden administration is from the Trump administration. And so that is going to be the dynamic that we're going to see over the next 4 weeks. Really, again, reminding the public, reminding the world what his legacy is. And one of the things that we saw in the last 24, 48 hours, was this move towards reaffirming his IRA bill, right, the Inflation Reduction Act, and getting that money out the door. That's part of this legacy-setting agenda. And while the Trump administration has had a very aggressive rhetoric, right, around anti-climate change, pulling back on clean energy tax credits, et cetera, it's our view that actually clean energy is likely to do well under Trump. What we saw during the Trump administration is that clean energy outperformed traditional energy, and it was vice versa, converse underneath Biden. So even though they had all this fiscal spending, all these tax credits being offered, clean energy underperformed. And that's really because a lot of the clean energy sector functions like a growth stock. And so that's what we're focused on, and on the clean energy play, is that even though there's all this legacy setting happening and that one president or administration might have a priority, you also have to look at market technicals as well as global demand.
So let's talk about something Trump said last night, which a lot of people are questioning. Fast permits, if you have $1 billion investment into the United States, I immediately thought of, well, isn't that Nippon Steel taking over U.S. Steel? What does he mean by this, or is just something he wants to throw out there for a vibe?
I think we have to see how that would actually be interpreted. What are the deals? If we are backing off on M&A aggressively as far as monitoring that through the FTC, that could allow for faster permitting through faster deals, moving through the legal system more quickly. So that's a bigger picture sort of umbrella structural change. Now, I don't think it's all smoke and mirrors, because it reaffirms his commitment to that pro-growth strategy and policy. So lower taxes as well as that deregulation play. This is just part of that narrative. How it actually plays out, we have to see, because I don't know what those investments are, right? We don't know yet. And we don't know what agencies would be involved and what permitting, right, would be involved. So again, we have to see how it goes, but it's essentially
Are they American? Are they foreign?
It sounds like it would be foreign, right, as far as bringing investment to the U.S. That was my interpretation of his statement, is that it would be from, offshore coming to the U.S. Again, part of that, right, pro-growth, America First policy, right, essentially bringing jobs here. And that's where you see a little bit of this conflict between Biden and Trump, is that Biden is saying, I'm not going to let U.S. Steel go offshore. Right, that's one method of trying to save American jobs and be pro-growth. And then you have the other, right, which is the Trump strategy we just talked about.
But that pro-growth strategy has already got the soft data ticking up a lot. There was, from the Business Roundtable, a CEO Economic Outlook survey, and CEO optimism is the highest in over 2 years. The details of what they said I thought was really interesting. They pointed to a lot of what you're saying about pro-growth, but said that he will avoid the overly broad tariffs. Are CEOs of America, is corporate America ready if there are some serious tariffs put into place?
If it sounds like they're not, right? If that's what the survey says, it sounds like that folks are not preparing for that. And really what we have to track when we're thinking about our investors and our clients is if this is sweeping, what does that mean for really the consumer and constraints there? And then if it's not, where are those idiosyncratic risks? And how can we signal ahead of time and get ahead of it with our clients? And so that's really what we're focusing on when we're interpreting the tariffs.
What about regional exposures as you interpret the tariffs, as you interpret the various picks for various positions? How are you seeing what fares the worst, whether it's Europe, Latin America, or Asia?
So across those lines, obviously Asia would fare worse. You're thinking, again, this continuation of the aggressive U.S.-China tariff regime. I think that the Mexico, Canada, USMCA 25% tariff could be soft. I think that that is more of a talking point. It's part of this broader renegotiation that'll happen in 2026, and there's a lot that can happen in a year. So I'm not as bullish on the 25% on Canada and Mexico. But obviously, Asia is going to be a primary target for not only Trump but also Rubio in their international affairs.
On the domestic front, we are getting some of the personnel. The chessboard is filling in, and one of the members, one of the chess pieces, is Andrew Ferguson to come head the FTC. And I do wonder what you think that means with respect to handbags and grocery stores, not necessarily what it means to big tech, but do you think that Andrew Ferguson would be more amenable to some of these deals getting through and kind of reinforces the optimism that we're seeing about some sort of M&A boom?
Yeah, I absolutely agree with that statement, that it could reinforce that M&A boom across the board. What we're looking at is not just tech. I know that's how we have tended to think about it, is that's tech industry, but also for our own industry, financial services, we think that there's likely to continue to be M&A activity there. So I think that it's going to be sweeping and it's going to be a top-down order, much in the same way that when Lina Khan stepped in, she completely changed the tone of the agency. So this is really his opportunity to reshape that.
Is there going to be, though, a thread that follows through from Lina Khan to Andrew Ferguson in terms of big tech? Because that is something that we've seen Trump talk about. And also Trump's FTC in the first iteration, Trump 1.0, were the beginning of some of these big tech crackdowns. You think of the likes of Google.
So one of the things about big tech that I always like to emphasize from a policy perspective is that the biggest players in the room have the ability to respond to the DOJ, the FTC, any sort of actions that they can take because they have enough revenue, right, to respond. It doesn't hurt their valuations over the long run. Where I would say the real risk is on tech would be if they continue to focus on smaller companies, and so that deregulation play is going to help growth more significantly. Obviously, on the upper ends, you can be a little toppy already.
Monica Guerra, thank you so much for being with us. Monica Guerra of Morgan Stanley, as we assess what the potential ramifications are from the chessboard in Washington, D.C., and frankly, in Mar-a-Lago, Florida. Right now, we're watching Macy's shares fall more than 8% after downgrading their full-year forecast. A real question here, Danny, about how much this really goes to a fundamental weakness versus just simply an errant employee.
Right. They're using this as an excuse, but is this just another excuse like people aren't willing to pay as high prices anymore that mask over a strategy issue more broadly?
Which is the reason why you've got activist investors circling around this storied name. Coming up, more on what we see going down in Washington, D.C. Congressman French Hill, as President-elect Trump looks to boost American industry, and as he has his eyes on the Financial Services Committee. This is Bloomberg Surveillance.